move in the so-called sort of wrong direction from a stagflation standpoint. I think, falling on a weakening economy, one would argue that perhaps it'd have even more negative effect than it would have had, in prior, last few quarters.
Alan, a general question here. Let's call it Econ 101 this morning. I believe there are 14 core CPI measurements in each country. Is there a value to looking at headline inflation now, or do each of us have to find a core series we're comfortable with?
But I think core was seen as helpful in terms of telling you what the underlying picture was, where the natural gravitation would be over, say, a 12-month period when food and energy prices, erratic food and energy prices, work their way out. But I think if you're asking questions about, what is inflation doing for the average man in the street, then skip the core. I mean, you've really got to focus on the total inflation, and, it would be a travesty, really, to start removing food and energy from those kind of measures. But I think core for the economists trying to look, say, 12 months out is still reasonable, and you've got to search country by country, I'm afraid, Tom.
When you look country to country, I just want to wrap it up with this question about Europe. And we've been talking a lot about the U.S. and the fiscal spending in the U.S. and how we're going to see the dollar progress. But at what point does Europe become attractive again, considering how much it sold off, but also considering that it faces a much bleaker picture in many ways than the United States?
Yeah, I mean, obviously a lot turns on the politics. So you had somewhat optimistic mentions of the U.S. touching base with the Russians, which is, I think going to egg people to think in terms of some sort of Ukraine peace deal eventually. That's obviously an optimistic view of things. So that's going to be crucial, I think, in terms of, how you think about Europe going forward. That being said, I think there is some built-in resilience that we're starting to see from the economies. You are seeing an ability to navigate some of the energy shocks. So I don't think it's all pessimism, really, in a way. But I think you're still going to have to just wait for that political signal before there's a real buying opportunity.
Alan, thank you as always, buddy. Appreciate your time. Alan Ruskin there of Deutsche Bank. On a week ahead, on the year ahead. The missing part of this conversation is China and China reopening. We had a week of rumours last week. We had health officials out of the country reaffirming their commitment to COVID zero. Bit of scenario analysis came from Goldman over the weekend as well. Tom, if you drop COVID zero and deliver a full reopening, they're looking for a move of 20% on Chinese equities. 20%.
Yeah, I guess that doesn't surprise me in the sense that I look at the GDP statistic, which is the gloom of under 3%, 3, 4, 5, dare I say 6, it's nonlinear. And every single point of GDP they get up, that's what makes that equity pop as well.
The commodity market pop as well, I think is what we're all looking for. And Bramo, you and I have had the conversation. What are you looking for?
I'm looking for flights to Milan.
Okay. You keep looking and you let me know how
I'll let you go. Well, no, who cares? Red will pick
you at the front of the plane and me at the back, as always.
Yeah, thank you.
No doubt about it. Lisa, we're trying to work out whether it is bullish. A China reopening is bullish or not, based on just a simple equation. If it reopens the supply side of things, great. But if it injects massive demand back into the economy at a time where things are still somewhat constricted, particularly when it comes to energy, where does that leave us?
Well, and especially the Apple story kind of highlights this.
In a big way.
There's not really certainty about why they are reducing production. They are saying it is because of some of the COVID restrictions. They are saying in a statement that they are concerned and feeling that there are some sort of fissures just in terms of their employment picture. Other people reporting, including Bloomberg, that the demand side is cooling. So at what point is the supply side response going to come too late to be disinflationary where you already have demand cooling off that's negative for the global economy?
I think we're all trying to work that out. The other issue as well, and I'm pleased we're talking about this ahead of the midterms, there is this kind of universal consensus view in markets right now that if we get a divided government, it's good because it restricts our ability to deliver a big fiscal package to help an economy that's in a downturn. Now, maybe that's true in the short term. I just don't know about the longer term. If you end up in a situation where we don't have that counter-cyclical fiscal buffer in a time when the economy's rolling over and the Fed's still committed to keeping interest rates at, say, 4, 5%, who knows what, next year, will we still view it in quite the same way?
Alan Ruskin pointing to the even greater issue that the lag effects are great for fiscal stimulus as well. And we will still see the boost from the fiscal stimulus of the past few years for 2023, 2024. It's after that that the real entrenched pain happens and that you won't be having that fiscal support.
Back to the important question. Did you get prices?
I'm working on it. The seats are going like hotcakes. Olivier Giroud is really something.
Giroud.
Is he too old?
So you know what the rumor was over the weekend? So he got a yellow card
Yeah.
and he scored late in the game and he took his shirt off. So when you take your jersey off, Tom, you get another yellow card.
I did that last week.
So he got himself sent off, and people believe he deliberately got himself sent off so he could be fresh for the World Cup. Do you like that?
Okay.
Genius move.
Is that a genius move?
Genius
That's
move.
fun, though. I mean, he's like the real deal. He's like out of Central Castle.
Just trying to distract myself from what you said moments ago. From New York, this is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Ukraine's President Volodymyr Zelensky wants Iran to be punished for helping Russia. Zelensky said if it wasn't for Iran supplying weapons to Russia, quote, we would be closer to peace now. Both Ukraine and the U.S. say that Russia is using Iranian drones in the war. The head of the International Monetary Fund says global inflation may be close to its high point. Kristalina Georgieva spoke to Bloomberg at the UN Climate Exchange Summit in Egypt.
It is very possible that we are peaking. We now see central banks very united on fighting inflation is top priority, and rightly so. If we don't succeed, it would be anchor, and then the foundation for growth, which is price stability, is dented.
Georgieva also said it would be a struggle to bring consumer price gains down to a more palatable pace. Philip Morris International will go ahead with the $16 billion takeover of nicotine pouch maker Swedish Match. The maker of Marlboro's received support from enough shareholders, including the company's largest one, Elliott Management. Swedish Match and its U.S. distribution network would give Philip Morris a foothold in the biggest market for alternative smoking products. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
You will put a woman on Mars. You will bring forth global cooling. You will be the first chief crypto officer. Because when you subscribe to Bloomberg, you won't just get news. You'll get insight into limitless possibilities, knowledge, and inspiration to feed your ambition. So before you invent, pioneer, disrupt, before you change the world, Bloomberg.
City.
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
How
story.
are you thinking about those dynamics?
Hydrogen has a very special place in the universe. It's the first element on the periodic table. It is the most abundant element in the universe. And when clean energy advocates think about what can we find which would be as easy to use as fossil fuels, they think about hydrogen. The fuel that will, when burned, only produce water.
We like to imagine that if we just built enough of these and these, we could ditch fossil fuels and save the planet. Unfortunately, it's not that simple. There are some things where you just need good old-fashioned combustible fuel. Now, startups around the world are betting that hydrogen can become the fuel of the 21st century.
This is going to be a wake-up call to President Biden, and I hope he answers it, because what's happened over the last 2 years has really caused a lot of problems in America. I hope that President Biden sees what Americans are gonna say to him on Tuesday, which is we're not happy, and we need a different agenda.
Governor Glenn Youngkin there of Virginia speaking on ABC over the weekend. Live from New York City this morning. Good morning. Futures up 0.6% on the S&P 500 after a week of losses. Down on the week on the S&P last week by a little more than 3%. Yields higher through last week, lower this morning, down 3 basis points on a 10-year to 4.1314 in the FX market. Euro dollar 99.81, positive 0.2%. Question many people asking over the weekend, Tom, is how long we'll have to wait to get all the results, particularly if we get a runoff.
Yeah.
Georgia.
Well, this may extend our trip down to Washington. We'll be there Tuesday and Wednesday, and of course, we will be there through the month if we have many, many different hung races.
Which
it's
take
not
an
just
extra 4 weeks.
Yeah, it's not just another 1 or 2 races, though, John. It's like 5 or 6, 7 races.
Pretty much.
It depends how much Georgia's going to matter ultimately, but it looks like it's going to a runoff regardless.
Yeah, Axios out with a smart article today on gerrymandering. I love their phrase. They call it, I believe they call it dumb-mandering, where some of it hasn't worked out. Right now, and this is a joy, we truly begin our coverage with Wendy Schiller, director of the Taubman Center for American Politics and Policy at Brown University, with Greg Vallier, just a foundation of what surveillance does on politics. Professor Schiller, I want you to address, as in your memo, the midterm messaging that has led us in the last 48 hours to indeterminate polling. Give us the messaging dynamic, red and blue, versus the polling shock that we're going nowhere in the last 2 days.
Well, what's interesting is sort of a very late shift by the Democrats. We've talked about this before, to the economy, and also attacking Republicans on Social Security and Medicare. The problem with that strategy of the Democrats is many people who are over the age of 65 already voted. That's the biggest bulk of people who vote by mail. And also people between the ages of 41 to 65. A lot of that early voting is coming from them. They care about the economy. It's just a little bit too late, I think. And, they misplayed the abortion issue by overemphasizing it nationally and not being strategic about that. They did some redistricting decisions that we could talk about. We don't have time. In 2020, we have that case in Rhode Island where they over-districted, in other words, put too many Democrats in one district and left the other district vulnerable. So now we've got a potential for a Republican to be elected in Rhode Island for the Congress. That hasn't happened in a long time. So I think, on the other hand, the Democrats had a lot of losses in 2020 in the House. So, the damage actually might be mitigated. In other words, the Republicans can pick up a lot of seats and win control, but it won't necessarily look like 2011 or 1995.
Where are we on the tipping point where the mail-in voting, the pre-voting becomes more important than the Tuesday voting?
That's a really great question. Places like Pennsylvania, for example, we're all watching that state Senate race in particular. They start counting Tuesday morning. So you may not have that kind of blue wave, red wave kind of thing going on. It may take them a long time. There's about, I think, 550,000 or 600,000 early votes by mail, but they start counting at least on Tuesday. It's some other states like Ohio. They accept mail-in ballots for another 10 days. So, if it's really tight in some of these states, it could be a while before we know the answers. But midterm elections are about a referendum on the party in power in the White House. Most of the time, that party loses seats. When you have such division, you're going to switch control of the chambers a lot more frequently. 20, 30 years ago, we didn't have as much division. And so, it's harder to flip control. But it is typical for the party in the White House to lose seats in a midterm election.
Wendy, is this a referendum on this administration, or is it a larger referendum? There was a story in Axios basically talking about how leading Democratic voices are saying the party is seen as too extreme, and that this basically is a big clarion call for a rethink in some of the messaging more broadly. Do you agree that that is the conclusion if the Democrats do face some pretty severe losses this particular week?
Lisa, I think it's just so much more complicated than that, and I would be cautious of over-interpreting the results of this particular election. People are concerned about inflation. It's still hard to get a new car. There's ridiculous inflation markups on new cars, for example. I mean, people feel it. They feel it every day. This could just be a big example of bad campaigning by the Democratic Party in terms of messaging. They had tons of money, and did they not emphasize what they should have emphasized, sort of average campaign 101? And in terms of democracy, if we have turnout, we already have more early voting than we had in 2018, by about 1 million votes already. And we don't even know the full extent of early voting. So if we have really big turnout and you say democracy is dying, that's a conflicting message again. So the Democrats have to be cautious. Everybody has to be cautious about interpreting the results of this particular election. But it is true that the Democrats did a lot, they say they did, for a lot of the people who are not voting for the Democratic Party in November. And where is that mismatch most acute? And how do they have to localize their messaging as they move forward?
Well, especially when it comes to crime. And I say this living in New York City and living in New York, and we have seen this become a huge campaign issue that actually makes this highly blue state suddenly on the ballot when it comes to the governor race. What's your interpretation of that? And I understand that there are single idiosyncratic messages, but is this just a messaging issue or is this a policy issue?
Well, I mean, in terms of crime, the irony for the Democrats, or the frustration for the Democrats, is that part of the violent nature of crime is that more people have guns. It's just easier to get a gun, and many more people have guns. That's due to basically Republican/NRA opposition to gun safety legislation. But the Democrats have just lost that message entirely. And it's true, people want to be safe when they go into a supermarket or a movie theater or the subway. Wherever they are, they want to be safe. And it's been typical that the Republicans have taken advantage of that in electoral terms. And there is also sort of a racial coded message in criminal, sort of focusing on crime in some areas as well. So the pushback by the Democrats against that messaging hasn't been exactly the right mix of messaging about security versus being, cautious on using racist or stereotypical tropes on crime. So I think the Democrats have some work to do on messaging. They also have to figure out who's going to run their party. They have people who are, no offense, people in their 70s and 80s, all good, but they have a fairly old bench. And the Republicans have a fairly younger bench, with the exception of Donald Trump, who still has a lot of vitality. But nonetheless, you had the governor of Virginia, relatively young guy, probably has a future in national politics. The Democrats have figured out who is there, who are their spokespeople, and what age group are they picking from. And that's a big rethink for them, and they better do it fast.
Wendy, thank you. Wendy Schiller there of Brown University. I think you missed that at the end, Tom. Perhaps for the best. Wendy, thank you very much. We're talking about consequences. We're thinking about the fiscal policy consequences. Let's talk about foreign policy. The one area of agreement down in D.C., if you can pick one, China. A story just out from the Wall Street Journal that Xi Jinping, according to people familiar with preparations for a trip, is planning to visit Saudi Arabia before the end of the year. Tom, what do you make of that? Just out from the Wall Street Journal moments ago.
I think as an activist, not only the Chinese leader, but all leaders, Mr. Putin is a little distracted with the war, but it's not a United States in a vacuum, and often with our different definitions of isolationism, we want to work in a vacuum. We don't have that luxury.
You mentioned the war. Lisa, we got to think about where the support will be to support Ukraine.
Yeah.
Particularly if you get a divided government in D.C.
You have an increasing push to remove some of the support, because why are we helping when we need to have help at home given some of the price rises? And especially if you do see a softening economy, a complicated picture, especially China's heading to Saudi Arabia?
Yeah.
That is interesting.
Isn't
I wonder especially how much is that ahead of opening up from COVID-0 and all sorts of things too. And
I guess the rumour mill going, doesn't it?
Well,
hasn't travelled much at all over the last couple of years.
And now suddenly where is he going? Fascinating.
Futures up 0.6% on the S&P. Live from New York. Big week ahead. I say that every Monday. Big week ahead.
It is.
This is Bloomberg.
about cryptocurrencies? Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies. And I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent the demand falls, then the price would go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you've just said, why would you not put a big short of some type on cryptocurrencies? Or maybe you have, but do you think that's a good short?
Well, you know, when we look for these subprime, the reason why we shorted the subprime in size because it was asymmetrical. You're shorting a bond at par that has a limited duration that trades at a 1% spread of treasury, so you can't lose more than the spread in the duration. Yet if it defaults, you can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, you know, went from 5,000 to 45,000, you know, I would be wiped out on the short side. So it's just too volatile to short.
No one covers the world like Bloomberg.
The writings on the wall for the Bank of England. Just Stop Oil has spray painted the front door.
Recession in Europe, UK, and possibly the US.
Brazilians are out in full force celebrating the election victory of former President Lula da Silva.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this How story.
How are you thinking about those dynamics?
The economy is not responding to the Fed's tightening. And so they've got a lot more work to do.
The signals that we would expect to see after this much of tightening from the Fed, they're just not there right now.
You could get to a terminal rate that's even closer to 6% if inflation does not abate.
The Fed is setting itself up to reverse some of this policy tightening.
We haven't seen the Fed raise rates so rapidly before. We haven't had coronavirus economy, and we haven't had inflation like this for 40 years.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures right now on the S&P positive 0.5%. TK later this week. America decides, and it's CPI just around the corner.
Yeah, America decides CPI, and I agree with you. It's equally as strong as this election that we're going to see in the next 2 days. And as you mentioned, John, we're going to have results coming out after Tuesday as well. The market today shows that indecision, if you will, of decision 2022 is it's a churn here. I'm watching oil more than anything.
Question of the week, and I asked it of you an hour ago. Bramo, it's your turn. If you could have the result of one thing right now, would it be the midterms or would it be inflation in America?
It would be inflation in America. It would be CPI for the next 2-3 months. It would be the outcome of the election for the next 2-3 years. And I think that that is the distinction because the near-term rally is really being driven by the CPI. The longer-term fiscal and just political backdrop will drive more long-term.
And from the previous hour, the distillate here is gridlock, less fiscal stimulus. I think that's sort of the summary.
Positive in the near term, and I think we're all asking the right question here. Is that positive in the longer term? If you can't deliver a counter-cyclical fiscal buffer, when you need one, is that positive next year? Now, that's going to hinge on where inflation is and where bond yields are. And if inflation is rolling over and bond yields have reset lower, then maybe that's the kind of thing that you might want in that environment. But Lisa, that's a lot of questions that I haven't got a clue, and I don't know the answers to.
Nobody has the answers to any of this stuff, which is the reason why you get a churn and people saying that it's a technical bear market rally that's going to have legs because why not? And people trying to come up with an explanation for this type of price action. Good luck. Have a good time, because honestly, it's not particularly lucid in terms of the narrative that's consistent.
Thank you, Lisa.
Anytime.
Futures right now, up a half of 1%. Let's whip through that price action. Bramo's going to run you through the day ahead and maybe even a week ahead. Yields look like this on a 10-year, down a couple of basis points to 413.56. Yields last week higher, much higher, particularly on a 2-year. Talked about the range on a 2-year, though. 40 basis point range on a 2-year, Tom. Last week, very close to 480 after Friday's payrolls, and now back down to about 468.
Okay, back down, but I'm going to suggest all of the fixed income data we have is still elevated. It's come back a little bit from Wednesday, Thursday, Friday, but nevertheless hasn't given back all that much. I look at the real yield, same idea.
To Lisa's point, it all comes down to CPI a little bit later this week.
Yeah,
Euro dollar going into it. Lisa, 99.80, positive 0.2%.
Yeah, and here's the issue, is that yes, the U.S. is facing a pretty serious inflationary wave, but so is Europe, so is the rest of the world. And this really is the reason why it's so hard to game out what the implication will be in terms of a market narrative following a CPI report one way or another. 9 a.m., we have European finance ministers meeting in Brussels. This is really the front and center for what they're talking about, too, a 10.7% CPI rate for the Eurozone. Where is that headed? What can the ECB do? What can they do if the fiscal policy response is broken, essentially? You can't flood this market with money and solve the problem simply because money is the problem when it comes to how quickly inflation has been accelerating. Today, we get a host of Fed Speak. How do they really message on this? Boston Fed President Susan Collins and Cleveland Fed President Loretta Mester will have a discussion around 3:40 p.m. Richmond Fed President Tom Barkin is speaking at around 6 p.m. How do they talk about the conflicting dynamic between employment and fighting inflation? We've been talking about how this isn't really a big issue right now. When will it become an issue? At what point will inflation have slowed enough for them to start thinking about a dual mandate rather than a singular mandate? And after market, the earnings is sort of trickling to a close with Lyft reporting earnings. Lyft last week talked about cutting jobs. We keep hearing this from the big tech companies. Meta saying that they're cutting thousands of jobs. Twitter, its own beast, obviously, because of the whole Elon Musk excitement over there, but cutting half the jobs. And then did you read about this, John, that he now is asking some people to come back because they were fired in error, and he needs to get some of them back in?
That's what happens when you make cuts quickly. Work out maybe you need to make some changes. Bramo, thank you. Messy, Tom. Seen a lot of cuts
messy
in tech.
is the exact right word here, and I don't have any punditry to add to it other than messy describes.
I wonder how messy the Fed Speak's going to be. I got this message on Twitter from a gentleman called Nick in the last hour or so. I fear the Fed speakers in the next week are going to sound as unified as members of the Kardashians choosing a restaurant. Tom, that could be messy too later this week. Fed speak in America. Do you know who the Kardashians are? You do know who the Kardashians are. Of course you do.
What's the allusion there to choosing a restaurant?
It's going to be difficult to choose a restaurant.
Really?
They're not going to be on the same page, Tom. They might be arguing.
This is getting painful.
There's multiple Kardashians? I thought there was just one.
Michael Schau joins us now, CEO of Market Field Asset Management. Michael, I'll skip that one.
Indeed, thank
you. We'll go straight to CPI and midterms.
Indeed, thank you.
You know what's coming, though? If you could have the result of one right now, would it be CPI or the midterms?
I think the midterms, and I was thinking back to 2010, where we had a 1-2 then as well, which was the midterms took place and QE2 took place within 24 hours. And the market rally we had was everybody sort of pointed to QE2 and said this is really what got the market going. But I always felt the midterms is what got the market going. I think markets prefer gridlock generally to one party having control of all the levers of power, particularly when that party has an aggressive agenda, whether it was Trump as he was in 2017-18 or the Biden administration today. And so, if the news of the midterms, really gave you a sense that the Democratic agenda was going to be put on hold for a couple of years, I get your point about no counter-cyclical fiscal policy, but I think the market would be happy to, put doubt to one side, doubt of new legislation.
Then if you've got a tripod here of the election, does it change Fed policy, which tempers the market towards a bull market because Fed policy adapts to a new world?
I mean, perhaps. I mean, there's no doubt the fiscal cliff did have an impact on
Yes.
Bernanke in 2013. I think right now in the current environment, the Fed is very sort of one-minded. It feels it needs to deal with inflation. I'm sure it understands that it made a big mistake 18 months, 2 years ago in not understanding where inflation was going. I don't think it affects policy in early 2023, but I think there would be a point that, yes, the Fed may be left as the only lever of loosening if we ever get to the point in the economic cycle where that's required. It seems quite distant today.
So every week we say this is a big week, and every week feels like a big week. We get a data point, we get something that helps shape a narrative for us in terms of where we are in inflation and where we are in the Fed fight. How has your belief in terms of what's going to outperform, how you should basically invest, how has it evolved as we've gotten a labor market that remains hot, we get a Fed that's willing to go further than people ever thought was possible, and only seem to be increasing their longer-term forecasts?
I mean, these things don't happen that often, but this still looks very normal. This looks like a cycle that the Fed let get out of control in the same way as we saw in the 1970s, and that requires an awful lot of catch-up and eventually leads to overshoot. I mean, to me, the big story behind the Fed of 2022 is the sectors which have done better and the sectors which have done worse, and it really does look as if technology leadership is over. I say that because it went down a lot, and it hasn't bounced a lot. And I think that really, really matters because you now have a sector that dominates market cap in the S&P 500. It absolutely dominates active funds. And coming into the last sort of 10 weeks of the year, which is the point at which everybody kind of sits down and decides what they want to do. I don't think we've got 10 weeks left if I really think about it. I think the temptation to rotate out of tech is going to be powerful. Now, it's not great news for the S&P 500 at the index level, because technology, as I say, dominates that index. But it might be pretty good news for the sectors that get some of the money that comes out of tech.
Without tech leadership, though, do we see gains, right, on a broad index level?
No, you certainly can have a range-bound market in which certain sectors do really well and in which certain global markets do okay. It's very difficult for the S&P 500 at the index level to make broad gains that take you back through that August high. I think that's a remote possibility, but I think it's possible to make money in this market.
And Michael, this raises massive questions for a generation of investors who have been told by their advisors at home to stay long US equities over a certain time period because that delivers you robust returns. And history shows that.
It does, but it can be a long time, history. It took 13 years between 2000 and 2013 for the S&P to get cleanly through 1550. If you were a passive investor for that period of time, you were living off your dividends, and that felt like a long time. Now, during that 13-year period, there were multiple opportunities to make money. There was a huge global bull market in the early 2000s. Obviously a very strong commodity bull market during that period of time. And plenty of money to be made within the S&P 500. But if you simply owned the S&P and sat in it, that was a 13-year wait.
This is a big conversation that I think needs to happen a whole lot more. The prospect of a lost decade for a massive chunk of the equity market, I'm not going to ask you whether that's what we face here, because you can't answer that with any degree of confidence. But do you think we're underestimating the risk of that, given that the conversation barely happens?
I think a passive investor who bought the S&P 500 or the NASDAQ in November, December last year is in for years of remorse. I just don't think it's going to be a great place to be. That doesn't mean they have years of continuous losses, but they're going to start with a beating, which they've had this year. They're probably going to lose more money at some point next year. And it's going to take an awful long time, I believe, for the S&P 500 at the index level to cleanly get through its peak of 2021. Now, other portions of the global equity market, including portions of the US equity market, I feel much better about.
Michael Schall, do you want to finish with that pocket of the market you feel good about?
I think energy's been the big story of this year. I would expect that to be the case through the end of the year. And at some point, the dollar will peak and global equities will be investable again. Not quite sure we're there yet.
Got to squeeze that in. TK, that's a big call from Michael.
It is.
The years ahead of us.
It's about coming down to low single-digit returns, which is where the actual assumptions really get threatened.
Michael, awesome to catch up. From New York City this morning, futures up by 0.6%. CPI just around the corner. Bramo says it's a big week. It must be a big week.
It is.
Midterms coming up soon.
You said, come on.
Well, what if people just tuned in?
Well, then you can blame me.
You, wonderful.
Yeah, great.
All right, great. Great. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. and Russia reportedly have held private talks on ways to avoid escalating the war in Ukraine. According to the Wall Street Journal, a peace settlement wasn't a goal of the discussions. The Biden administration was said to have warned the Kremlin against nuclear weapons. France's President Emmanuel Macron says the U.S., China, and other non-European rich nations must pay their share to help poorer nations deal with climate change. Macron is attending the UN Climate Change Summit in Egypt. More than 100 world leaders are expected there. They'll attempt to maintain momentum in the battle to limit planet-warming emissions. Over in China, exports and imports unexpectedly fell for the first time in more than 2 years. Overseas, consumers bought less, while demand in China was hurt by COVID-0 controls and a housing slump. Brazilian exports had been a major support to China's recovery in the past 2 years. And Twitter is asking dozens of employees it laid off last week to please come back. Elon Musk cut close to 3,700 employees last week to slash costs. Now, Bloomberg's learned that some were laid off by mistake, and others were let go before management even realized they may be needed to build the new features Musk wants. And Bloomberg's also learned that Apple expects to make at least 3 million fewer iPhone 14 handsets than originally planned this year. The cutback is due primarily to softer demand for the iPhone 14 and 14 Plus. Apple and its suppliers now aim to make 87 million of the devices or fewer. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
Most fascinating entrepreneurs because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably can spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, of the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
How
story.
are you thinking about those dynamics?
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding, and the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
How are
story.
you thinking about those dynamics?
On November 8th, as Americans decide the future of Congress and state legislatures, Bloomberg will be live in Washington, D.C. to cover the results as they break and provide insight about what it means for the country.
We're in a divided country, and these are really close elections. We take a look at what the races could mean for Wall Street.
Special election night coverage starts at 8 p.m. on Bloomberg Television and Radio. And tune in to Surveillance live from D.C. at 6 a.m. on Wednesday for the latest overnight. This is Bloomberg.
The party in the White House usually loses during midterms, but the reality is we still have a very strong pathway, not just to keeping the Senate, but really picking up seats in Pennsylvania, and in places like Wisconsin and North Carolina.
That was Senator Cory Booker there of New Jersey speaking on ABC over the weekend, live from New York City. Good morning to you. Equities higher by 5 or 6/10% on the S&P 500. Equities up and yields lower by 2 or 3 basis points on a 10-year, 412.93 on 10s. In the FX market, the euro dollar, 99.80, positive 0.2%. I have to say, the governor of France, Guy Johnson, said it earlier out of London today. You don't usually see the governor of France this hawkish, but pretty hawkish this morning, Tom. As underlying inflation has clearly not peaked, we shouldn't stop on rates, and they want to keep on going. They want to keep on hiking.
I'm glad you bring this up. Lisa had the chart of the day on radio. It looked exquisite, which is just a vector moonshot up of EU inflation. And let's begin with the November 10 inflation report. Inflation in Europe is different than here. It's sustained double digit.
You can make the argument, and I've said this a few times, that maybe peak year-over-year inflation in America is in our past, and in Europe it might still be in our future. That's problematic because Europe is experiencing economic weakness already up front in a way that perhaps the U.S. economy is not.
We will see. We'll continue right now with our election coverage. Your futures up 22. John, is that a high for the day?
Close. Just off them, Tom. Just off them.
25.34 on the VIX. It is something from your childhood where you show up with your parents. This is all pre-mail. At the election, and depending on what state you're in, you are 100 feet from the polling station under New York Education Law Section 2031-A. That's what they do in New York. Anne-Marie Horton knows this. She lived it in New York State. Anne-Marie, tell me about the safety of voting this time around. It's percolating in the zeitgeist that as we have for 250 years, there may be a little tension when we vote.
There are more things like poll watchers, and some say that these individuals are actually drawing concern for individuals that show up, the way they're dressed, unsure who they are, and maybe trying to influence or discourage people. There's a lot of talk of that, but we also have to say, in this election, as the prior election, there's also a ton of people that are just voting early by mail. And that also means that you don't need things or concerns about poll watchers. But this is something that has become highly political. And we heard from the RNC chairwoman this weekend on CNN, State of the Union, and she was saying that there should be no violence when it comes to poll watchers, but there should be poll watchers there to make sure that people can have the right safety of mind that the election is being carried out as it should be.
Anne-Marie, let's go to breaking news of some form, and it is another poll looking at minorities in America, the Latino vote, the black vote, Wall Street Journal with an update on this. To me, it was pretty much the trend that continues, which is it's an ever-growing Republican presence. Is it a tipping point presence, or is it just at the margin?
It does look like at the moment that they're just gaining more of these votes. It's not like these votes are not going to be coming out really in high margins and numbers for the Democratic Party. But what the concern is for the Democratic Party is that they're losing a huge part of their base. And I really look at Nevada, when you especially look at the Latino vote, and the fact that the incumbent Democratic senator is the first senator to be of Latin American descent, a Latina, and potentially she is going to be losing her seat. And the issue for these groups, Black voters, Latino voters, is the fact that inflation is really starting to become front and center for them, especially in a place like Nevada, right? It's a huge industry that supports Las Vegas. These are very much so middle-class voters, and just the price of energy, food, rent, all of that is going up, and that is why you are seeing this shift.
Emery, we've been focused a lot on the Democratic Party and the loss of a number of seats as expected and as highlighted by these polls. With the Republican Party, how much is Donald Trump still the front runner in terms of setting the tone as he charts a path for 2024? And how much is it really moved beyond him to the issues that you're talking about that are attracting a growing number of people to the GOP?
Well, just this weekend at a rally, he literally put up a sign of the polls showing that he was double digits, way ahead of Governor Ron DeSantis, which he has a new nickname for that individual, as well as also his former Vice President Mike Pence. He is the clear leader at the moment of this Republican Party, and this is why you see a number of Republicans want him to come to their rallies, right? He was with Marco Rubio over the weekend in Florida. He's going to be with J.D. Vance, the Republican hopeful in Ohio. He is for sure the leader right now. The question is the next 2 years, does he really make the final comeback bid and he's the name on the ticket, or does he end up playing kingmaker?
MH, final question from us. How long is this going to take to get the results?
Well, it potentially could take till December if Georgia goes into a runoff. So you have to consider that we might potentially not know the makeup of the Senate until just before Christmas. But, you know, it can take anywhere from the 24, 48 hours to maybe even a week.
Unreal. AMH, thank you. Down in D.C. TK, we could be doing this for another 4 weeks, potentially.
Oh, particularly the Senate.
Well, you look at the polls right now, and it looks like Georgia's going for a runoff, right?
Yeah, but I would suggest, and this is particularly important for people not tuned in over the weekend, the polls have tightened up over the weekend. I think that's the major message Monday morning, is it's not where we were Thursday.
I want one single name in the pre-market to look at right now, and I know Lisa's going to talk about it again in about 5 minutes. Apple, it's down by 1.9%. So Apple came out yesterday evening and said that demand for the iPhone was still robust, but ultimately, because of difficulties producing the thing out of China, they've got to clip supply of those handsets. We're reporting that actually the supply issue is one thing, they've also got a demand issue. And they're putting a number on it in our report as well, Tom. Apple expects to produce at least 3 million fewer iPhone 14 handsets than originally anticipated. Right. This according to people familiar with the plans. The reduction is primarily due to softer demand for the iPhone 14, 14 Plus model, cheaper alternatives to the high-end Pro offerings as well. That's our reporting this morning.
Yeah, it's there, and I really want to listen to people here. I think there's some confusion over this between the high-end models, which I'm speaking as an amateur, are the Pro and Pro Max, versus what you just said. It's confusing, the other 14s, and I really don't understand that distinction.
Well, I think we've also got to separate what we've heard from the company, Lisa, which is supply is going to be hit, but demand's still good. And what we're hearing from our reporting, which is that we can put a number on it, and it's not all about supply.
Especially given the chip story that we've been talking about, we've been wondering, why are we not seeing that in demand forecast from Apple? If people are not demanding as much of these goods, why isn't it affecting them? Well, maybe it is.
Apple down by 1.8%, down by 1.9%. We'll get you some morning calls on that from the analyst community a little bit later too. Futures up by about 0.5% on the S&P 500. We're doing okay. From New York City this morning, good morning to you all. This is Bloomberg.
Go.
After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
Bloomberg is live at COP27 in Sharm el-Sheikh, Egypt. Bloomberg Television and Radio brings you continuing coverage as world leaders, business insiders, and decision makers gather to take action toward achieving the world's collective climate goals.
What are your top 3 priorities?
There is an ability always to find the new and innovative ways to meet the challenge and at the same time take into consideration the pressures that exist.
Special coverage continues only on Bloomberg, your global business authority.
Live from New York City this Monday morning. Good morning to you. Here's the price action trying to build on the gains of Friday this Monday, with equity futures positive about 0.5% on the Nasdaq 100 up 0.4%. Last week, the Nasdaq 100 staging a recovery on Friday, but ultimately down on the week by about 6 percentage points. The worst week of the year so far, going back to January this year. So that was a big move lower, helped out by what's happened in the bond market, or rather, the help hasn't come from the bond market. A move of more than 20 basis points last week on a 2-year, and a range about that wide at the high, very close to 480 at the low, very close to 440, and right now somewhere in between with a 2-year at 467.97. As the price action in the bond market, we look like this in foreign exchange. Just briefly, looking ahead to the Fed speak, Lisa went through that a little bit earlier. I wonder how divided they will be. Not seeing that division from the ECB. European Central Bank and the governor of the Central Bank of France, to be precise, talking up more interest rate hikes, Tom, even with the economic weakness on the agenda for us all to see.
John, I don't get it. I'm going to go back to what Governor Bailey of the United Kingdom said the other day, looking at the length of 2-year recession. How do you raise rates into that length?
They're looking to do it, Tom. They're looking to do it, and we can keep discussing it. That's the cross-asset price action. Let's get you some single names. We can do that with Lisa. Hey, Lisa.
Hey, John, and you were talking about Apple. We need to start there, but I wanted to connect it to what Michael Schawel was talking about just moments ago on our show, where he was saying that he does not see tech leadership reasserting itself anywhere in the near future. What does this do, and how much have we actually seen that priced in and reflected by some of their earnings estimates? Apple really is one of the main outliers when it comes to a more positive outlook than some of the other tech names. What does this latest information about them paring back the production of the iPhone 14 say about how long they can remain insulated from what we're seeing in the semiconductor space and what we're seeing more broadly within tech? And the shares down 2.1% ahead of the market open. Blue Apron, another one of the pandemic darlings. Everyone wanted to have home cooking kits in order to create some variety when they were home all the time. Those shares down 17% almost as they remove estimates, as they remove their guidance for the full year because things are disappointing. And Lyft reporting earnings after the bell. They are one of the ones that are cutting jobs. They're cutting 13% of their staff, they said last week. Those shares up just about 2%, but another one of those that perhaps is going to face off with some serious competition with Uber as the world gets to be a more discretionary place. And Meta, cutting thousands of jobs, Tom. Those shares are lower by more than 70% so far this year. That is just shocking to me to take a look. This is pretty much the poster child of a tech bubble that has popped.
Yeah, Meta, Facebook, 87,000 shares. How many are they talking about laying off?
They're thousands. That's what
Thousands
they're saying. They're going to be talking with people, and people have been looking for some sort of paring back. Those shares are up in pre-market trading because people are saying you've got to cut expenses, like you and John were talking about earlier. This is what it comes down to.
And we'll see it across industrial America, no doubt, in the path we're taking as well. Futures up 19. Joining us now, Megan Green, Global Chief Economist, Kroll Institute, Senior Fellow at Brown University. Thrilled that she could join us this morning. Megan, I look at the linkage of this election into economics. In the heart of it, by one source, is rents, housing, mortgage makes up 33% of the family budget, the monthly budget of families, singles, whatever. How big is the inflation story wrapped around housing costs?
Yeah, so Tom, housing is a huge weight in the inflation basket as well, depending on which basket you're looking at. It's pretty big in all of them. And of course, it feeds through with a pretty big lag because most of us are, signing leases once a year at most, if even that. So I think housing inflation will continue to feed through into the overall basket. And that's why when we get this inflation print later this week, it'll still be much higher than the Fed wants it to be. I think it could come down a bit from last month's at least. So it could decelerate a little, but it will still be really high.
Well, in the economic world, the Fed world, should we partition out rent and look at other disinflationary tendencies? Or do you have to look on a core basis in the aggregate?
Yeah, I think what you have to do is look at everything. I know that's a classic economist two-handed answer, but I think because rent is such a big piece of household spending, it's important. That's why it's reflected in such a big weight in the basket. But of course, inflation is a deeply personal experience, right? If you own your house and you've paid it off, you're not that affected by housing inflation, even if the overall inflation figure is high. It doesn't hit you. Whereas if you have lots of medical costs, for example, and you have inflation in healthcare, then that would really hit you. So I think we need to look at all different kinds of calculations of inflation. That includes the one the Fed looks at, the PCE, which calculates or weights housing and healthcare actually differently than CPI. But I also think we need to look at measures of underlying inflation. And there, I think the New York Fed's underlying inflation gauge is very interesting. It's not that great as a metric of where inflation actually is, but it is really good at predicting inflection points. And it suggests that peak inflation may be behind us. So that could give the Fed a little bit of reason for optimism.
Where are we heading, Megan? How long will it take before we get to 2%, or is that basically a pipe dream, given the global winds and where we are?
Well, no, I think inflation will come down over the course of the next year. Will it hit 2% by the end of next year? I don't think so. But I think very few economists are actually asking what the world and the economy will look like on the other end of this, when the dust is finally settled, when we don't have war or a pandemic or any of these successive supply shocks. And, I think when we are on the other side of this, actually, we'll still be stuck in this secular stagnation environment with a glut of global savings. If you think about the main structural factors driving lower inflation over the past 15 years, it's things like technological innovation, market concentration, low worker power. Those things have all been turbocharged by the pandemic. The only thing that hasn't been turbocharged is globalization. That's been a driver of lower inflation. And there, I don't think we're actually deglobalizing. I think we're just globalizing more slowly. Now, there's one way I could be totally wrong about all of this, and that's if we're really serious about the green transition. And there, I think the answer is different in Europe and the US. But if we are really serious about it, we are going to be pricing in the cost of carbon, which we've been considering zero before. So that will inherently be inflationary. I just don't think we're that serious about it, particularly in the US.
Megan, how does the political backdrop really factor into this? And we've been talking about a lack of fiscal spending and how that's being viewed as a positive in markets. How do you play that out in the inflation outlook and honestly, just in terms of growth over the longer term?
Yeah, so if you look at fiscal spending, and this goes for the US and also the UK and Europe, if there's a drive for austerity, then that's going to be a drag on demand. That's going to push us further into recession, and that will bring inflation down. Whether you consider that a feature or a bug is up to you, but it will be disinflationary at least. And the second piece of the elections, the implications for inflation, get to the point I just made about the green transition. If the Republicans take the House, I think we're less likely to have any major efforts for the green transition over the next couple of years. And so that's also less inflationary than it otherwise might have been.
Megan, do we understand the lift we've seen in hydrocarbons? I was just working on the Bloomberg. Folks, this is easy to do on the Bloomberg. There's just terrific commodity coverage. Natural gas off the bottom is up 290% off the summer of first-year pandemic. Diesel, a gallon of diesel is up less. It's up 190% from that summer of 2020. Do we understand in our punditry the shock that we've seen in hydrocarbons?
I think we do. I mean, a lot of it is supply and demand coming from successive shocks from a war, but also coming from OPEC actions. And so, I think we were in the developed world, particularly in the US and Europe, facing an energy crisis before Russia invaded Ukraine. And now it's hit us all in the face because it was accelerated when Russia invaded Ukraine. But I do think if you talk to energy analysts, they've certainly seen this coming for a while. Most of us were ignoring it, particularly in the US, because we could conveniently. Oil prices weren't that high. They've all gone up now, so I think we are having to face this.
Unavoidable this year, Tom. That's for sure.
I have forgotten this. These three charts I just looked at in the Bloomberg: natural gas, gallon of diesel, gallon of gasoline up 113% off the bottom. I think we forget the scope and scale from the summer of 2020.
Massive moves. Megan, thank you as always. Megan Green there of the Kroll Institute. We're just going through the Southside stuff on Apple. Lisa went through the difficulties that company is said to be having at the moment. B of A, Barclays, cutting price targets on Apple this morning. Deutsche Bank talking about the risk to Q1 estimates. JP Morgan doing the same, implying downside to Q1 estimates. Tom, that's the story for Apple this morning.
Well, it's going to be readjustment, and I believe we have D&I scheduled 164,000 employees. A lot of that, I assume, is retail in the stores as well. But is it unimaginable that they would go through some form of layoff like what we're seeing? And Lisa mentions Facebook.
We're seeing a ton of layoffs in tech, aren't we?
Yeah, I mean, it's just an adjustment.
Real cuts.
Yeah.
Is it just an adjustment, Tom, or is it something bigger than that?
I don't know. I did an NFT, and I think I was top of the market. It hasn't worked out.
What did you buy?
I made it.
You made an NFT?
We made an NFT at home, went down in flames.
What was it?
It was an image of Vet Bill and Kennel Fee, and, just sort of digitally with a surveillance. They were wearing surveillance swag. It went down in flames.
Did you sell it to anyone, or you just...
No, I did not sell it. In fact, it was like, just didn't work out. But, remember SPACs? Was that like 2 cups of coffee ago?
That was a good time, wasn't it?
That worked out.
That's ridiculous.
And what does that mean for Wall Street? This is a Shonali Bassett question, but what does it mean for Wall Street? I believe it's November. They got weeks to adjust to figure out the game plan for January and February.
I think they'd love to see some economic stability return so we can get some real deal flow again. And Lisa, right now, we're not getting that, are we? At all.
No, although maybe next year, if there's consolidation, it won't necessarily be the free-for-all, but we might get some consolidation. Just on this point, though, of the layoffs in big tech, you do wonder at what point they've really right-sized and you could start understanding what the future is. I keep thinking about what Michael Showell was saying.
It's super important.
It was really interesting how we are just seeing the end of tech leadership as we know it. And there is more to come. And I wonder what this looks like given the growth, the generation of a lot of the salaries.
That sounds super bearish, but I say this because it's worth the discussion. Lost decades aren't unheard of.
I'm with you.
And if you think that asset class might go through one of those, then what does it tell you about a major weighting on the S&P and just being long the index?
Well, yeah, and that's the headline index. But there could still be gains. And at what point does that shift back to Europe because of the tech dominance?
Oh, the global story?
Yeah.
We're going to do the global thing again. How many times have we said buy Europe, Tom?
Exactly. Or as Michael Shaw alluded to, exactly when do you buy international?
Sure. When the dollar starts to
When the
weaken,
dollar weakens. Good luck with that.
Futures right now are 4/10 on the S&P. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Ukraine's President Volodymyr Zelensky wants Iran to be punished for helping Russia. Zelensky said if it wasn't for Iran supplying weapons to Russia, quote, we would be closer to peace now. Both Ukraine and the U.S. say that Russia is using Iranian drones in the war. Ryanair has lifted its passenger goal for the year and downplayed the likely impact of a recession. Europe's largest discount airline said earnings should top $995 million.
We've seen very strong forward bookings and fares into the October midterm, school midterm. Christmas looks very strong. Next Easter already, next summer looks strong forward bookings. But we'd be cautious into this winter again. Everything looks good. I mean, what's unusual is this time I think we're going into a recession with full employment. People do seem to be spending, and they're certainly traveling.
Ryanair says it will offer 10% more seats this winter than it did before the pandemic. Facebook parent Meta Platforms reportedly will start laying off thousands of workers this week. According to the Wall Street Journal, the job cuts could come as early as Wednesday. Meta had been struggling with growing losses. Plus, it's also been investing heavily in developing its metaverse business. Shares are down about 73% this year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Satellites have propulsion systems. They can kind of move to get out of the way of each other or change their orbit a little bit. It's a service that you guys offer to help these companies know how to maneuver their machines.
Yeah, we offer a collision avoidance service. It's a subscription service. We'll send you an alert up to 7 days in advance if your satellite's going to come dangerously close to a piece of debris or another satellite.
Companies have been doing that for decades, moving satellites around, but it's sort of like a harder problem now.
The risk of a collision is a lot higher now, just because we've installed so much more hardware into space. You have a big collision, it creates a cloud of debris, and now all the other satellites are flying through this whizzing mess of debris. As we add all of the new satellites into space, the risks of the collision, the likelihood of the collision is going up.
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
From New York City. We're in London, in Sydney,
in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
How are you thinking about those dynamics? Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
I'm a little bit cautious. I don't want to be 100% hedged at $92 a barrel because I think there's as much risk that oil will fall below $90 a barrel into next summer or that it will rise to $120 a barrel. The situation is just too uncertain. I think we're comfortable where we are.
Michael O'Leary, always great to hear from the man at Ryanair. Always fantastic on TV as well and on radio. Live from New York, here's the price action. Your equity market shaping up as follows on the S&P 500, going into an interesting week ahead. On the S&P, up 0.4%, a yield to lower by, let's call it 3 basis points on a 10-year, 413.14 on a 10-year, and in foreign exchange, 99.80, Tom. Firmer on the euro side of things, up 0.2% on that currency pair. Crude 91.80 was softer this morning after a big rally recently. WTI just north of 91 and down by about 0.9% on the day.
Let's go to oil right now. Something I'm watching. Brent crude just dipping under 98, 97.81. Regina Mayer knows this. She's global head clients and markets at KPMG with real expertise on hydrocarbons. Regina, if China comes back and there's the whispers of China coming back, what does KPMG think? What does a more buoyant real GDP in China, a reopening China, mean for Brent crude?
Well, I think that just creates a lot more upward price pressure, Tom. The thing that's keeping us relatively mild is we continue to expect increased demand because China still really has not come back in the way that we expected. And we haven't seen the impact of inflation and recession on consumer demand for hydrocarbon products. And we're already in a tight supply situation that you and I and others have talked about probably ad nauseum. So if China comes back, I think that's where, as a previous CEO said, that's where you get into the triple digits for WTI and Brent.
You've got a huge Texas and middle of the country feel. What is the mood of not Exxon or Chevron or the others? What is the mood of the independent oil producers out there as we go into this election?
So I don't think that we're expecting a lot of dramatic changes regardless of what the outcome of the election is. But the mood in Central Texas is, still pretty mixed, right? We're achieving great financial results in large part because we're benefiting from higher commodity prices. But the days of drill, baby, drill, and we're going to frack until the cows come home are long behind us. And Wall Street is really what's driving the oil patch, particularly in the U.S., not Washington.
So let's talk about that, Regina, especially as you have the confusion from President Biden talking about no more drilling after demanding more drilling. This confusing message from Washington. Is there a very clear message from Wall Street? And if so, what is it?
The very clear message from Wall Street is dividends, returns, shareholder value, free cash flow, focusing on return on investment. And they're not increasing drilling and production in the way that we normally would have expected to see with this kind of frothy price environment. We also, though, the sentiment is also, though, affected by labor, which we've talked about, economists have talked about this quite a bit, shortage of labor and supply chain cost increases for core materials. So those are impacting the ability for the shale players to radically increase production, as well as their sensibilities and sensitivities around delivering shareholder value in the wake of what their investor community is demanding.
Do you think that it's likely that we will see the $72 a barrel price tag that this administration has pinpointed as a place where they'll start rebuilding the Strategic Petroleum Reserve? Or do you think that we have seen close to the lows for the next year or more?
It's a tough one to call, Lisa, but I'm not as bullish on long-term crude price for the into 2023. I think that with supply continuing to build up, with things settling down in terms of the overall market, if we get a calmer sensibility of what's happening with the hostilities in Russia, I'm hopeful that we can get back to more sensible oil prices in the mid-2023s. To be perfectly frank, this commodity price environment is not good for the industry, and it's not good for our globalization. It's not good for individual countries either.
Regina, what is inflation doing to our future production of oil as a general statement? You're at a meeting with KPMG and somebody goes, well, it's not double-digit inflation, but it's 6-7% inflation. What does that do with the margin to oil production?
Yeah, no, it's creating a lot of pressure on margin, right? So labor costs are going through the roof. As I mentioned, there's the supply chain challenges. Cost of capital is going way up. there's what's interesting about what government has done when you look at the Inflation Reduction Act and the infrastructure spend, there's more incentives and more long-term liquidity that the government is providing in the form of grants and loans that will continue to spur investment in emerging technologies like carbon capture and sequestration and hydrogen and direct air capture even and renewables, but not for hardcore fossil fuel investment, which we need in the short term for energy security purposes, but because we're in this high price environment. So we're sort of in a negative cycle that it doesn't spur the right activities, and Wall Street's really calling the shots.
Well, Regina, let me just put a bow on it then and ask you this question. Are the midterms a factor or not in the outlook for the commodity story?
We don't believe that it is. And when you look at what the legislation that was passed with the Inflation Reduction Act, coming off the back of KPMG's Global Energy Transformation Conference, we had traditional energy companies and emerging energy companies all seeing benefit from that legislation. So I think you're going to see broad-based support across the industry for what has been done. You know, what I'm hopeful for is we can decrease the level of hostility and aggression when we talk about the energy industry, because without all of us working together collaboratively, we can't solve these major technology issues that affect climate. We have COP27 going on right now in Egypt and affect our near-term and longer-term energy security requirements.
Regina Mayer, thank you, as always, of KPMG. Crude this morning down 9 cents on WTI, $91, and let's call it 80 cents on Brent crude, 97.84. We're down, Tom, about 0.75% there.
Well, you just have to watch it, just based on news flow. I mean, you're 1-2, oil shortage, China demand stories, some $100 Brent crude. But again, I would go to the lift in nat gas up to 7 in the United States, and I haven't looked at the follow-on from copper with the China Open off LME. Lisa, we look at LME for copper.
Thank you, I appreciate that.
Thank you.
That's helpful, Tom.
Yeah, thank you.
Please, Lisa's on board.
Well, I just want to point out that what she said, what Regina Mayer just said, was fascinating. That basically, it does not matter the political sphere. It does not matter the political backdrop, that Wall Street has spoken, and we're not getting that kind of investment. Now, what that does to prices, that remains a debate, right? So she's saying perhaps it's not that bullish for prices, whereas other people say, particularly JP Morgan, structurally, this is the reason why prices of crude are going to be so much higher.
This is why people are bullish the oil patch.
Right, exactly.
I think if you're a bull right now, you don't want that story to change, do you?
Exactly, because they're not going to drill, so that's not going to be sort of the elasticity of increased supply. So that's going to be, basically just causing there to be, anytime there's a surge in demand.
The China reopening story, I still don't get. The rumor mill doing the rounds, and we've heard from the Chinese over the weekend from the National Health Commission, they're going to resolutely adhere to the strategy of COVID zero. It seems to be no change at the moment, but the conversation continues.
Yeah, talk about mixed signals.
Futures up 0.4 on the S&P. This is Bloomberg.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
You will put a woman on Mars. You will bring forth global cooling. You will be the first chief crypto officer. Because when you subscribe to Bloomberg, you won't just get news. You'll get insight into limitless possibilities, knowledge, and inspiration to feed your ambition. So before you invent, pioneer, disrupt, before you change the world, Bloomberg.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this
How
story.
are you thinking about those dynamics?
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
No one covers the world like Bloomberg.
The writings on the wall for the Bank of England. Just Stop Oil has spray painted the front door.
Recession in Europe, UK, and possibly the US.
Brazilians are out in full force celebrating the election victory of former President Lula da Silva.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
We're not seeing cracks in the labor market yet, and so the Fed is going to have to continue on its path.
This is going to be a very slow grind into this weak labor market.
What do we know so far about the inflation call? Everybody's gotten it wrong.
The consumer has the savings buffer. The savings buffer is coming down.
I don't think that consumers are really seeing the type of stress that would lead this economy into recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on a Monday before a most important Tuesday. We welcome all of you on radio, on television, in Washington tomorrow, and the following day with an indeterminate election, I'm told, John, on Wednesday morning as well. I love what John Anzalone, writing with a Democrat-Republican poll of the Wall Street Journal in the last half hour on Latino, on black votes, and he says this election is a paradigm shift. Are we going to see a paradigm shift in that inflation
It's
report?
amazing, Tom, amazing. Let's start with the election and then go to CPI. Yeah. It's amazing to see the president campaigning in New York, a state he won by 23 points in 2020. Yeah. That's just amazing to see, and we can talk about that later. We've asked the range of guests this morning what they'd be watching, the midterms or CPI. I think you both said CPI this morning.
Caveated.
With a near-term, longer-term outlook, and Lisa framed it nicely, I think. In the near term, you want the CPI read. But in the longer term, when it comes to the midterms, you want to understand the composition of DC to really get your hands around whether we can have any kind of counter-cyclical circuit breaker whatsoever if this economy rolls over, because the Fed is saying we're unwilling to provide it. In fact, the objective is to slow down growth. And I don't think we have the fiscal space at all, even if the Democrats wanted to do more, based on what we saw take place in the UK.
Or will they? And is the paradigm shift here, John, that we'll have fiscal gridlock? And that seems to be the, I'll call it the tendency this morning is towards gridlock.
If you ask people on Wall Street, they'll say that's what we want. And if you dig a little bit deeper, it'll be because something like they don't want people to do lots of spending, complicate the Fed's effort, boost inflation, all that good stuff. I get it. But the conversation that Lisa and I had in the last couple of hours is basically, okay, that's the short-term story. But if you land in about 12 months with inflation lower, bond yields lower, and you get that fiscal space once again and it returns in Washington, and you can't provide that buffer in a downturn, I wonder how bullish people will think that is at the time.
My reality is inflation is front and center. We see that. We mentioned rents with Megan Green earlier. We see the oil price, Brent crude 97.83. Lisa, I wandered through Whole Paycheck this weekend, and I'm sorry, aisle to aisle, it's tangible.
Whole Paycheck really is just that. Though this really raises an issue of how long it will take to crimp that, whether it's just the Fed's job, and how long it will take to really understand what we have done, both with the withdrawal of fiscal as well as withdrawal of monetary support, how long it takes to bleed through and what the damage is that it does to the economy. And so we're looking for a CPI report. Maybe it'll show us a 7 handle. Okay, 7.9%. Great, it's going down. Not quickly enough. And the drivers of it are still very much in force.
With that, are we going to get an election report? John mentions New York State. For our international audience, the governor from Buffalo challenged maybe downstate, is how I'd put it. But we're going to get an inflation report Tuesday evening with David Weston.
Well, so how much is this really a read on inflation, right? In terms of the election and the outcome, and Kathy Hochul, I would say in New York, the reason why this is such a hard election to get your arms around is that there are different issues that are driving people to the polls in different places. And so you're seeing a very disparate message with inflation in the backdrop, but also at the forefront, other social issues very much, whether it's crime, whether it's abortion, whether it's, you know, something else that's really making people come to
John,
vote.
Data here. We've got some breaking news we got to cover, but John, I'm sorry. I think the foreign view is important. I look at the British ballet and I'm going, this is crazy. How do you look at the midterms?
The midterms?
Yeah.
From what perspective? From a market's perspective?
No, from a John Farrell
Considering that you're British.
From an AC Milan Tottenham perspective.
Let's do it from a Georgia perspective.
Okay.
The outcome of the Georgia runoffs in early 2021 were hugely consequential for everything that happened in markets for, I would argue, the next couple of years. Would we be having this conversation in the way that we are if you didn't have the outcome of those Georgia runoffs in 21 go the way they did, Tom? Would we have had a fiscal package that large? How different would this conversation be politically if this White House wasn't able to get its way? Because you wouldn't be able to sit here and blame the White House, would you? You wouldn't be able to sit here and blame fiscal stimulus in quite the same way.
The White House, is it?
So when it comes to Georgia, we face the very real prospect of a runoff again. And we'll speak to the experts about what's happening on the ground there. But you need to get above 50. If you don't, you go for a runoff 4 weeks later. And it looks like that's what's going to happen. So if everyone's looking forward to waking up on Wednesday morning with some firm set of results to go ahead and just kind of fade this whole event and start buying equities again, we could well be in a situation where it takes a number of weeks to find out the answer to that.
I agree. I do not see this as a buy signal coming Tuesday night or whatever. Let's do the data right now. I'm going to look at Brent crude 98.21, John. We're buttressed up there, not through the highs of Friday.
I'm going to look at euro dollar just briefly. North of parity a little bit earlier this morning, back down to 99.95. Looks like a sale, doesn't it? 99.95 euro dollar.
Well, especially when you say it like that.
I've got a future. I was told I've got a future trading cattle. Euro dollar 99.5, 42 cents, you know, all that good stuff sold.
Yeah.
Sold to the good man in the bow tie. Your 10-year yield down 3 basis points, Tom, 412.72. Do you like that?
Does
that work for you?
like that in British auctions?
They do that too, of course.
They do the whole cadence thing?
Yeah.
Okay.
Do you like that?
Let's continue forward here with debt. Futures up 20 right now. Anders Persson is not looking at futures. He's looking at the bond market. Chief Investment Officer for Global Fixed Income at Nuveen. Anders, what I love about your report is you say you've got to go out to high yield rather. You've got to go out to certain loans and notes. Provide a distinction there. What part of not full faith in credit, not quality corporate is the best opportunity?
Yeah, good morning. Thanks for having me. I would say we're very much focused on making sure investors are diversified right now. I think our key message to investors is that we are facing uncertain times. Many of the things that you just discussed here this morning and a lot of the different outcomes that we're all debating for 2023 will have very different outcomes for different parts of fixed income. But all in all, we're really focusing in on the facts that the income level opportunity is very interesting, and income generation is the vast majority of returns for fixed income more broadly. So from that perspective, we're looking at the higher income side of fixed income as an opportunity. We do like parts of high yield and leveraged loans. We're focusing in on the higher quality, the stronger credits, the ones with durable free cash flow, really making sure you understand what you're putting into your portfolio. And I think really active management is going to be ever more important in a year like 2023. Now, the area we like as well is preferreds. We do think that that's a space that's offering a little bit more attractive risk reward. We do think money center banks, financials, and what have you have really kind of a solid foundation to go into next year.
It's interesting that you're going into the riskier aspects of the market as we talk about the lag effects of some of the tightening, both on the monetary side as well as the fiscal side. How concerned are you that we don't really grasp the scope of the damage being done by raising rates as quickly as they have, as the Fed has, and by the idea that there will not be the kind of fiscal spending to offset any sort of pain in the economy?
Yeah, no, I mean, that certainly is a key concern here going into next year. And we're actually expecting more uncertainty, volatility. We're expecting spreads to go a bit wider, possibly retesting some of the wides that we saw in June of this year. So we certainly are being mindful of all the moving parts here. And if we were to go into more of a hard landing, then certainly some of these higher income kind of type asset classes will have a tougher time. I think what we're trying to be mindful around is that a lot has been priced in. If you're willing to take a little bit more of a medium to long-term perspective, legging into some of these asset classes, particularly if you compare to everything else that's out there. If you're looking at equities, we're much more comfortable with fixed income. And even, some of the private kind of type alternative spaces, we feel like public fixed income, particularly with diversified lens, is going to be more attractive.
I might have a football club for sale for you, Anders. Stick around if you want to buy that. Anders Persson there of Nuveen. Here it is from The Athletic. Fenway Sports Group, owned by and founded by, of course, John Henry, of course, known to you, many of you, because of the ownership of the Boston Red Sox. Tom, FSG inviting offers for a possible Liverpool sale. This, of course, is Liverpool Football Club. According to The Athletic, they're reporting that Goldman and Morgan Stanley have been retained to help with the process. TK, there's been some murmurings of this, I would say, over the last few months, but here we are based on The Athletic reporting.
This is different, I would suggest. I'm, of course, speaking, John, without your expertise, than any of the other turmoil in the Premier League we've seen. These guys are wonderful operators. It is without question they saved the Red Sox, and they saved old Fenway Park, combined with Tom Werner and the rest. These guys are competent, and what I suggest, John, they sell from a point of strength.
Oh, without a doubt. I'd go with that too. What did Chelsea go for? $5 billion US.
John,
a little north of 4 billion
weekend,
sterling. So
I
big
paused
numbers.
on YouTube and saw that magical point where the players come out with the little kids.
Sure.
And there's the tots and all that, but there's just that Liverpool red with the payroll and the quality of the players was solid at the end of the line. I mean, is it like the New York Yankees?
Well, I'm going to offend, not quite, but close. I'm going to offend maybe some Chelsea fans and look at that Chelsea price of about 4 billion sterling, 5 US, and say that Liverpool as a brand has more of an international reach in a way that Chelsea does not, specifically over in Asia too, if you just look at the fan base. And I would suggest that maybe that number is going to be bigger than that, based on that alone, and that's a very shallow set of analysis. And I'm sure the bankers will do a lot more work than that, I'm sure.
And I think
that seems to be the direction of travel.
Well, yes, and of course, folks, as we know, we need surveillance research on this, and we need to go up to Anfield. They've put a lot of money into the stands.
That would be cool if we went into Anfield, wouldn't we?
Yeah,
I was just waiting for you to say 5 billion. You have 5 billion, 5 billion, 6 billion. Anybody for Liverpool?
I don't know if John Henry wants me to do the auction process live on Bloomberg Surveillance.
Said we're going to have an auction. We're going to see if we can sell it. So there you go. I'm waiting for it.
We were talking about deal flow and banks trying to make some money. The Athletic reporting that Goldman and Morgan Stanley retained to help with the process. So reporting from The Athletic this morning, Tom, we'll see what happens here. Dan Ives might have something to say on this and on tech. The senior equity research analyst at Wedbush is going to join us shortly. Apple in the news. Apple is basically seeing production get hit. We're reporting here at Bloomberg that there is a demand story going on here. Apple says demand is still robust. We'll break that down for you in a moment. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. and Russia reportedly have held private talks on ways to avoid escalating the war in Ukraine. According to the Wall Street Journal, a peace settlement wasn't a goal of the discussions. The Biden administration was said to have warned the Kremlin against using nuclear weapons. In China, exports and imports unexpectedly fell for the first time in more than 2 years. Overseas consumers bought less, while demand in China was hurt by COVID-0 controls and a housing slump. Brazilian exports had been a major support of China's recovery in the past 2 years. Twitter is asking dozens of its employees it laid off last week to come back. Elon Musk cut close to 3,700 employees last week to slash costs. Bloomberg's learned that some were laid off by mistake and others were let go before management even realized they may be needed to build new features that Musk wants. Bloomberg's also learned that Apple expects to make at least 3 million fewer iPhone 14 handsets than originally planned for this year. The cutback due primarily to softer demand for the iPhone 14 and 14 Plus. Apple and its suppliers now aim to make 87 million of the devices or fewer. And impounded Russian super yachts are costing millions of dollars to dock and maintain. And American and European taxpayers, well, they're footing most of the bill. Bloomberg Business Week reports it can cost 10 to 15% of a yacht's value to keep it running every year. At an ultra-conservative 3%, the U.S. and Italian governments will pay more than $50 million a year to maintain their fleets. I'm Lisa Mateo. This is Bloomberg.
These floating flowers are made of 92,000 solar panels. Laid on the surface of a reservoir, they can generate 41 megawatts, which is enough to power 20,000 homes. It's one of the biggest floating solar plants in the world. Floating solar arrays have been gaining traction in Asia, including countries like Singapore and Thailand. Floating projects typically benefit from an easier connection to the power grid. They can also restrict algae blooms while keeping the solar panels cool. This one in particular has helped the local economy. When the power plant was first proposed, residents were given the chance to invest. Some locals were also offered jobs during construction. In fact, it was the community that requested the panels to be shaped as flowers to look more appealing. South Korea still relies heavily on imported fossil fuels, but will need to change that to reach its goal of becoming carbon neutral by 2050. Solar plants like this one may help the country reach its net zero goals.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
From New York City,
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
How
story.
are you thinking about those dynamics?
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding, and the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
November 8th, as Americans decide the future of Congress and state legislatures, Bloomberg will be live in Washington, D.C. to cover the results as they break and provide insight about what it means for the country.
We're in a divided country, and these are really close elections.
We take a look at what the races could mean for Wall Street.
Special election night coverage starts at 8 p.m. on Bloomberg Television and Radio. And tune into Surveillance live from D.C. at 6 a.m. on Wednesday for the latest overnight. This is Bloomberg.
The consumer has the savings buffer. The savings buffer is coming down. I think a high real rate is going to put pressure on the economy. I do worry about the corporate sector. The longer we stay at these high real rates, you're going to see credit contraction.
Love hearing from Priya Misra, the TD Securities head of global rate strategy. Big week ahead. Bramo keeps telling you CPI coming up a little bit later this week.
Low blow.
Midterms coming up too. I say that every Monday. Everyone knows that. Every Monday, Ferro's going to say, big week ahead, big week ahead. Futures really right now on the S&P.
That's the way the whole year's been. And it's
up
the
4
renewed
tenths.
volatility. The VIX is 25, John. It used to be 15.
I've got one
Every
stock
week's
to
a
watch
big weekend.
in the pre-market. Big move in Apple. Apple lower in the pre-market by about 1%. Not a major move, but a big conversation is taking place.
And we had it on Twitter, John and I apple picking this weekend. And John, you know, you look up the Hudson River, you look at the Macintosh apple versus the Paula Red. It's a tough decision.
Well, let's see what you can get hold of, and that's the problem. Where's the supply coming from? In China, things are locking down again. You see the difficulties around the region that produces the iPhone, and Apple is saying that they've got to trim expectations for the amount of production they can get. We're basically reporting here at Bloomberg that you can expect Apple to produce at least 3 million fewer iPhone 14 handsets than originally anticipated this year, not because of production difficulties, but because of demand.
Well, let's talk about that right now, and we will get, not on the Macintosh, that's old news, but on iPhone and Pro Max and that. We are thrilled to bring you Dan Ives, Senior Equity Research Director at Wedbush. Dan, you and I were talking about this. I need clarity on sales. The two fancy phones with the phone war that's out there, T-Mobile and all that, am I right that the Pro and the Pro Max are selling like hotcakes?
Look, I think demand on Pro has been unprecedented relative to what we're seeing in this macro. And I think you saw that with September results and even the guidance. And you see that even come out of China. But for Apple, as we saw last night, the issue is not demand, it's the supply. And obviously the zero COVID in China, that's the gut punch that we're dealing with this morning.
Okay, so weight that on a scale, and I don't mean to get mathy here, Dan, but I think we do with the Bloomberg reporting. What percent of this is about China lockdown? What percentage is about demand of the phones underneath the Pro and the Pro Max?
Yeah, so let's break that down. In terms of the Bloomberg report, that's really talking, when you look at iPhone 14 Plus, I mean, that's really been the strikeout for Apple coming out of the gates. That's where you're seeing the lower production in terms of coming out of Asia. But on the other side, the strength is coming out of iPhone 14 Pro. A typical mix is about 60-65%. We think it's closer to 80-85% this quarter. That's bullish. That's positive for ASPs, positive for margins, and that's really what the street's focused on here.
So, Dan, I guess that you're rejecting this idea that this could be demand-driven reduction in production. Is that correct? That you think that that's perhaps not a correct interpretation of Apple's announcement?
Well, I mean, if you look at just off the quarter, I mean, when Cook gave guidance, and I think across big tech, the last 4 or 5 years, no one's been better in terms of forecasting. They're seeing strength, and I believe iPhones would still be up year over year. But obviously, in terms of the zero COVID shutdown, we think that probably takes off 2, potentially 3% of iPhone units. Demand's not the issue. It continues to be supply, and I think that's the frustration for Cupertino in terms of what they're dealing with in China.
Although you're not necessarily seeing people expect bigger margins. In other words, we're not hearing that perhaps Apple will raise the price of the iPhone 14 in response to the lack of supply. So does this mean that Apple and a lot of companies have kind of reached the end of how much they can offset some of these pressures with higher prices?
Yeah, Lisa, it's a great point. I also think it speaks to why within the four walls of Cupertino, why it's so important from a chip and own their own ecosystem. And I think that's what Apple's done. It gives them more flexibility on the supply chain and from a margin perspective. And that's something that's playing out more and more. But I think really the narrative is that iPhone 14 Pro, despite obviously the dark storm clouds, is seeing strength, despite what we see, what I'd call almost a nightmare large cap tech earnings season.
Dan, in the hallways of all these fancy tech people with their egos and their business beliefs and all that, what's the difference between a hiring freeze and outright firings? Explain that body language, not company to company, but within the industry, within the culture you follow.
Well, in the Valley, especially in tech the last, I call it 7-8 years, I mean, a lot of these companies were hiring 15, 20, sometimes 30% more employees per year. So in terms of a freeze, they were just used to, if you need 10 more engineers in a project, you get it. Now what you're starting to see clearly a slowing down. You're starting to finally see these cuts. A lot of these companies are spending like 1980s rock stars. But you're starting to see now cuts across the board because they really want to make sure that they get ahead of this from a margin perspective. I still don't view it as ominous. It's still more between a freeze and slight cuts. If it continues, then it becomes a dark winter.
Hey, Dan, thank you. Dan Ives of Wedbush, still looking for 200 on Apple. Barclays this morning, equal weight on the stock, price target cut, 144 from 156. Apple warning on an iPhone 14 Pro production shortfall is what they call, quote, a rare move. The analyst Tim Long saying he's cutting his estimates for the iPhone 14 and AirPod units for the December quarter. Going on, Tom, to talk about that he's also picking up weaker sell-through signals in his own checks. So it's not just our reporting, others too, feeding into the big debate at the moment around that name.
Well, the big debate, and I get that it's China, but it's more than that. And I'm fascinated how Apple, who's essentially been untouchable, how do they adapt to it? I mean, they're not Lyft. Lyft adapts, cut, and they have earnings today, right?
Yep.
They cut costs. Does Apple, have I ever heard of Apple cutting costs?
I've asked the question of the analyst community, and I'll continue to ask it. When was the last time some of these companies had a true, real, cyclical test? And really think that through, because the pandemic is not it. Given the fiscal transfers we saw through the pandemic, Lisa, I would argue that that's not a good model to argue that they had a cyclical test. And in some spaces, big tech actually got an acceleration of demand from the pandemic. So that's not a fair comparison. When was the last time these companies had a major cyclical test?
And through the lens of Apple, because on a broader level, there's cyclical and then there's structural issues with respect to whether social media is popular or not, or you know, which platform is the star one at a given moment. But Apple, I'm thinking about this question of demand, and I'm also questioning how much they can really move away from China, right? I mean, if this is going to be an ongoing problem, and this is an area that produces 85% of the iPhone 14, how do they move away and create the infrastructure quickly enough to avoid this happening again in the near term?
How do they move away?
I'm not sure they do.
Without also harming the demand side of the equation in the country too.
That's a really good point. That's
do you
an
get that
excellent
kind of that pushback, that blowback from moving your production away from the country?
Apple's toast.
Yeah.
What's
Wait,
that?
they've been
Toast.
How
many times have we written that headline? 14 times?
14 times.
Every time the iPhones come out.
So we got a crisis. Well, we'll come back on this.
You were about to say we've got a crisis.
We got a crisis. We'll come back and talk about it.
I can't wait.
think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Bloomberg is live at COP27 in Sharm el-Sheikh, Egypt. Bloomberg Television and Radio brings you continuing coverage as world leaders, business insiders, and decision makers gather to take action toward achieving the world's collective climate goals.
What are your top 3 priorities?
There is an ability always to find the new and innovative ways to meet the challenge and at the same time take into consideration the pressures that exist.
Special coverage continues only on Bloomberg, your global business authority.
Hydrogen has a very special place in the universe. It's the first element on the periodic table. It is the most abundant element in the universe. And when clean energy advocates think about what can we find which would be as easy to use as fossil fuels, they think about hydrogen. The fuel that will, when burned, only produce water.
We like to imagine that if we just built enough of these and these, we could ditch fossil fuels and save the planet. Unfortunately, it's not that simple. There are some things where you just need a good old-fashioned combustible fuel. Now, startups around the world are betting that hydrogen can become the fuel of the 21st century.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
60 minutes away from the opening bell, live from New York. Good morning to you. Equity futures look like this on the S&P. They fade just a little bit. Still positive, though, up 0.2%. Big day of gains. The raise in a week of losses on the S&P 500 on Friday. The S&P down by about 3.35% last week. Yields much higher across the curve last week, particularly at the front end. This morning, yields a little bit lower by a basis point on a 10-year to about 4.15, Tom. No big moves here going into a big week ahead. CPI, midterms.
Yeah, big week.
What do you want to talk
absolutely.
about? What's a crisis? What's a crisis?
Talk about inflation
sure,
right now. The three of us to Milan.
How much?
Tots Milan, $38,000.
That's American Airlines.
That's United.
United.
You
Business to where?
Business to Milan.
Business to Milan. Okay.
Three of us, 12 times 3. That's where we are.
Try Zurich with United, and then we can get the train down. Often that flight can be a bit cheaper.
We could go after Davos. Fabulous, John. Thank you so much.
That's a plan.
That's a plan right there. Sheila Richardson with us, chief economist at ADP Research, and she's fabulous because not only working with ADP with her thumb on the pulse of American wages, but also her work on government economics. Thank you so much for joining today.
Thanks for having me.
You walked in and said, "Hey, stupid, this is what matters." In the media, and I'm as guilty of this as anybody. No, it's Monday. It's Stupid Monday for me. But the media overweights technology because we got technology in the brain. And you're saying layoffs at Lyft or Apple, wherever, is not that big a deal?
Well, it's a big deal for the tech sector. It's a big deal for tech employees. But in terms of the overall workforce, tech information sector is about 2%. So when
I never would have guessed that.
2%. So when you're talking about what's really the heavy hitters in the labor force, it's services. Services is, when it comes to consumer-facing services like leisure and hospitality, which we know suffered the most during the pandemic. Retail sector, that's important. Professional business services, so all your accountants out there, that's important. The tech is marginal.
What is this service dynamic into this election? Coming off the ADP report, coming off the full employment reports on Friday, what's the service dynamic right now?
It's all about wages, and it's all about leisure and hospitality, really, because that has been the big growth sector. It's interesting. In January of 2021, the wage growth in leisure and hospitality was the lowest of any sector we track. Now it's the highest, and it's been at double digits since the summer for a very long time. It's what's driving up wage growth. But as that dynamic changes, you might see wages start to peter out in terms of acceleration, but still remain high at these elevated levels.
We're all waiting for this supply side response. Any sign of it whatsoever?
Well, yeah, a little bit here and there.
Just a hint of it? Can you walk us through it?
In pockets. I mean, there was a little bit of movement, and I'm talking about labor supply.
Of course, yeah.
Hopefully we're on the
same page. We're on the same page.
We did see some people. There's so many supply issues here. But we did see some people move back into the labor market in the fall. We had the promise of a normal school season, and so that was helpful. But if you look at that labor force participation rate, it's still stubborn, and it retreated last month. That is an issue because that suggests a bit more permanence to the fact that the working age supply has, shrunk. And what does that mean for growth going forward? Not just when we get through this inflation cycle, but in the years ahead.
Well, this is the inflation cycle I wanted to talk about. So on the way up, inflation kicked higher really, really quickly. Do you consider it to be stickier on the way down? Is that the way this usually works out?
It's stickier, and I think it's going to be more persistent. The Fed's already admitted that the persistence is much more than it has been in previous cycles, that the supply shortages, those dynamics, globalization, automation that we're pushing inflation down they don't have the same power they used to. And the demographic changes are not having the same power it used to keep inflation low. So it's not only likely that this inflation cycle is stickier, that it's also likely that future levels of inflation are more persistent than we've seen historically.
You guys were talking about the supply issue in terms of workers coming back into the workforce. How can we understand the fact that the participation rate has not creeped up, that it is still actually going lower on a month-to-month basis if you look at the latest read? Why?
We all talk about economics, but we forget that there's a huge psychological factor undergirding this entire labor market. This was not just a supply shock. This was a people shock. And people over the last 2 years are making different decisions. They're giving up that second job. They're deciding to live on one income. They're switching industries, and we've seen that in the quits rate. So in combination, all these different decisions at the household level means that the workforce has become smaller. And so how do you get the workforce back up? Well, you might have to reskill workers for different jobs that make it worth it to get off the sidelines.
So what does that mean in terms of inflation and how quickly it can really come down? We were talking about how, at least on the product side, we are seeing some reasons to be optimistic about disinflationary forces, but not so much on the other sides based on what you're talking about. When do we get back to 2%?
Well, productivity is the fly in the ointment of the labor market. We need more productivity, and we haven't seen it. It's productivity that grows you out of this inflation stasis, right? It's when more workers are more productive, creating more output. Right now, we have more workers, but the same output or producing less output. And that's not the way you grow out of inflation. That's really the issue behind the labor market.
I did a tweet Friday out to Chad Jones, the giant out at Stanford on productivity. And let me ask you, because you're weaned in this. I mean, it's what you've done for years, Neela, and that is, how do you measure productivity of the new economy of work from home? I get that from a big corporation like ADP, work from home is maybe countable. But other than that, are we flying blind in this vaunted productivity analysis?
You've made a really interesting and really important point, because over the last 2 years, the economy has become even more digitized. And so the standard measures of productivity may not hold. And maybe there's some good news on this side, that we're actually more productive than we think. We're just not counting it right. But if that's the case, we should see that show up in GDP growth. right? And we haven't.
That's like Bloomberg surveillance. We know we're more productive than,
We are.
I mean, you look at our
Than everyone else.
productivity analysis. And
they don't give us credit for it.
We're just the hyper-voter. That's why I asked you the question.
Neela, I need to talk about policy then. Policy going forward from here. Are we at restrictive, and how restrictive are we, and how do we know?
Great question. We're restrictive in pockets. You can definitely see. Let's just put it this way. Where supply has been chronically short, like in housing, the policy works. But the policy only works because there's not that many houses to begin with, and prices were skyrocketing already. If there was a greater supply of housing, even a 7% mortgage rate wouldn't keep the tailwind of demographics at bay. But it's because that housing is chronically undersupplied that the rate is actually is having an effect. So where you have supply shortages and a higher borrowing cost, you're seeing an effect. It's not happening in the labor market, though.
And now, unfair question for Monday. You don't have to answer this if you want, but all of Global Wall Street watching us, listening on radio as well, want your update on the new ADP report. You know the pinata this has been, back to Dr. Zandi and all. What's the knowledge base you have about the quality of your new improved ADP report?
It's a different approach. We start with over 25 million workers, and we do something that is a pivot. Instead of forecasting the Friday number on a Wednesday, we provide an independent measure based on ADP client base. And this is the future of data.
Love it, love
this
it.
Is the
How
future
much
of data.
timeline do you need? How much statistical end do you need where you can say this has veracity?
I think we're in that moment now.
Really? We're there already?
We have a very expansive labor market. ADP pays 1 in 6 of U.S. workers in the United States.
I don't want to turn this into a commercial, but
I'm not trying to, but you asked.
You asked. You teed it up.
And so, and this
you
is
want
what
to sell terminals on the side?
This is where I'll broaden it, because the corporate sector is delivering with high frequency data. We don't just get a read every month. We don't just get it once a month. We get it every day. And I think ADP is not alone with other companies that are getting reads on inflation, on productivity. And so when it comes to the future of data, it's not just going to be with government statistics. It's going to be with the government as well, corporate sector as well.
I could sense the frustration. Does it frustrate you that if Wednesday doesn't forecast Friday, people just think it's useless?
You know, I have lots of frustrations, honestly.
Is that one of them?
When it comes to data. That's not it, because what I can say when I have an independent metric is, look, it's one of many. It's a supplement. Don't say this is a substitute. It's not. It will never be. But it's another read on the economy. And at a time when the economy has become more complex, more affected by rate sensitivity and government debt and fragmentation globally, you need as many credible resources as you can get. And so we offer this to Wall Street. Take a look. Disagree, like it, don't like it, figure out when it works for you, but it is another data point for you to look at.
They should clip this and put it on the website.
Yeah, exactly.
Doing a fabulous job.
Don't worry, we probably will.
Thank you for coming in. Always good to see
you.
It's good to see you in person. Neela Richardson there of ADP. TK, the payroll support on Friday, we've barely talked about it. Barely talked about it all morning. Just pushing ahead to CPI, pushing ahead to midterms.
The differential between the two series, the non-farm payroll series, which gets all the media glory, and the establishment series, I thought the differentials there were very nuanced. They always lead to, well, we need more data. But the fact is there's a real disparate view of the American labor economy.
Can I do my promo now?
Please.
Let me just get ready for it. There we go. In the next hour, Mike Wilson, the CIO and Chief US Equity Strategist at Morgan Stanley, will be joining us around the opening bell, 9:30 Eastern. I practiced that
What
just
did
for
Mike
you.
say over the weekend? Seriously.
Mike's basically talking about the potential of a midterm result that drives yields lower and fuels this equity bear market rally just a little bit more. But we also need to build on what we heard from the Fed last week, which I think was game-changing for many people.
Today will be
from the Fed officials.
From the Fed officials.
Do we start to see some division from then? Mike Wilson, 9:30 in the next hour on Bloomberg TV.
You have Ilarion on?
We don't.
Okay.
Might have John Henry on Liverpool. He doesn't know that yet, though.
He doesn't know it.
From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Ukraine's President Volodymyr Zelensky wants Iran to be punished for helping Russia. Zelensky said if it wasn't for Iran supplying weapons to Russia, quote, we would be closer to peace now. Both Ukraine and the U.S. say that Russia is using Iranian drones in the war. In Brazil, President-elect Luiz Inácio Lula da Silva will unveil a multi-billion-dollar spending plan to pay for social aid. It will be the first test of his congressional support even before taking power. Lula will need approval from Congress to break a constitutional cap on expenditures. Facebook parent Meta Platforms reportedly will start laying off thousands of workers this week. According to the Wall Street Journal, the job cuts could come as early as Wednesday. Meta had been struggling with growing losses, plus it's been investing heavily in developing its metaverse business. Shares are down about 73% this year. The northeastern U.S. is heading toward a winter heating crisis. Heating oil delivered to New York is the priciest ever. Retailers in Connecticut are rationing it to prevent panic buying, and there's warnings of a natural gas shortage. And it is all up at northeastern consumers. They face the highest energy bills in decades this winter. In Houston, furniture store mogul Jim McIngvale has won $75 million on his bets that the hometown Astros would win baseball's World Series. Now, that includes a $30 million payout from Caesars Sportsbook that the company calls the largest ever at a legal sports betting site. Now, some of McIngvale's winnings will go back to his customers. Those who bought a mattress for $3,000 or more will get their money back. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
What about cryptocurrencies? Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies. And I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent the demand falls, then the price would go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you've just said, why would you not put a big short of some type on cryptocurrencies? Or maybe you have, but do you think that's a good short?
Well, you know, when we look for these subprime, the reason why we shorted the subprime in size because it was asymmetrical. You're shorting a bond at par that has a limited duration that trades at a 1% spread of treasury, so you can't lose more than the spread in the duration. Yet if it defaults, you can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, you know, went from 5,000 to 45,000, you know, I would be wiped out on the short side. So it's just too volatile to short.
Ready, race, go.
After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
when it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
In London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
How
story.
are you thinking about those dynamics?
You look at all the polling data. If you all show up and vote, democracy sustained. It's in your hands. And look, you're one of the reasons why, as I said, I've never been more optimistic about the future of this country. I look at America reasserting itself to lead the world in the 21st century.
The President of the United States speaking there as we dash towards a Tuesday election. Again, we will be in Washington Tuesday and Wednesday with an understanding much will be undecided by Wednesday morning. There was one person I wanted to speak to. He is someone with the fabric of the Democratic Party of a good 50 years. He was Philadelphia District Attorney in 1978, and anyone in politics knows that would be the former governor of Pennsylvania, the former chairman of his Democratic Party, Ed Rendell. Ed, I want to know how you would pick up the pieces for the Democrats beginning Wednesday morning. There has been a liberal, a progressive shift. There has been what we've observed over 2 years of a Biden government. Fine. What's the Ed Rendell prescription starting on Wednesday?
Well, I would have started a little Wednesday. But Wednesday, we've got to come to grips with the fact that both wings of our party basically want the same outcome. They just differ about how to get there. And we've got to put those things behind us. We've got to learn the art of compromise among ourselves first, and then go forward. And secondly, we can't be shy. We should take a lesson from the Republicans. If they smack us in the mouth, smack them back. All this Democrats are soft on crime stuff the Republicans have been running. I haven't had right all day this weekend, past weekend, and tonight, saying the Republicans say that Democrats are weak on crime. They cite an increase in homicides. But all these homicides are increasing because of the availability of guns. Every Democrat voted to ban assault weapons and high-capacity magazines. Every Republican voted against it. So who's soft on crime?
Ed Rendell, I want to speak to a party, some would say hijacked by fancy people on the East Coast. How do you get back to mainstream Democrats, the people that Connor Lamb found attractive? You know, they found Connor Lamb attractive outside Pittsburgh. There's this arch Senate battle in your Pennsylvania as well. How do the Democrats move away from the perception of East Coast liberals to centrist Pennsylvanians?
Well, we've got to find the right candidate. And for example, I think Congressman Ryan is a great candidate in Ohio. I don't know if he's going to win, but boy, he's giving them fits. Because he's a candidate who people know represents their best interests. If I was running for office now, I'd go around with a big board, every speech I made, and the board would have the 10 issues that are most important to the public. And I'd say, where the Democrats have voted, where the Republicans have voted. And just hit them with the facts. We don't press the facts enough, and we get scared. We shy away from an issue. When someone attacks you, you can't ignore it. You've got to fight back.
Do you think that it was a mistake for Senator Fetterman to do that debate, given that he is still recovering from his stroke?
Well, I'll tell you, my Thursday right now. No, look, he deserves some high marks for courage in doing that debate. It was very difficult to do. The format was terrible. 15 seconds to answer a question about real policy. You can't do that if you're 22 years old. and tremendously healthy. So he deserves a lot of credit for courage and for his desire to be transparent. On the other hand, there were some tough images out of that debate, tough images of him not being able to put his thoughts together. And the interesting thing is, I was with him Thursday before the debate. He gave a 15-minute speech without stumbling for 1 second.
But Ed, there's a larger issue here, especially as we head into 2024, which is why has the Democratic Party not gotten a bigger bench of people to really become younger and more vocal and to get out there rather than just basically stick with people who have worked in the past and who are known but maybe haven't won?
18 are still there, are all young. Most of them are moderates. They're good Democrats and they're good candidates. And I think they might just pull this thing out for us.
Ed Rendell, I want to look back to William Scranton. He was one of your arch opponents, the Republicans of Pennsylvania, long ago. How do you perceive, Ed Rendell, the Republican Party after this election? And dare I say, if President Trump doesn't run again, the next GOP, what will they look like?
Well, that depends. If they're smart, they'll moderate a little bit, and they'll stop this election denying. Because in the end, election denying will hurt them. Because the independent voters, the moderate Republican voters, they don't believe the election was stolen. They know the election was. There were 62 court challenges, half of them before judges that Trump appointed, and not one of them won. The election was fine. Yeah. And by the way, if we were fixing the election in 2020 to 2020, we did a terrible job doing it because we lost seats in the Congress. So, no, we've got to get away from all this stuff.
Ed Rendell, thank you so much. We look forward to speaking to you at the Super Bowl with the Eagles here along January time. He is the former governor of Pennsylvania, always the gentleman from Philadelphia. Lisa, I look at that and, as we go into our election coverage, and I still go back to the heart of Ed Rendell, which was crime. And with all that he did in Philadelphia, I can remember the accolades there from Republicans and Democrats, but also inflation in the paycheck, which global elite Wall Street doesn't talk about.
But what do either party do right now about inflation? Honestly, what can either of them really do to mitigate inflation in the short term?
But the emotion changes the politics.
The emotion changes the politics, and that's the reason why it's going to be interesting to see what this means for the parties going forward, because it's ultimately a popularity contest for who they think is going to have a better say and a better voice moving this forward.
And I'll state this strictly anecdotally. As I went through whole paycheck this weekend, I never saw more items on sale in a grocery store than when I went through this weekend. Prices beginning to adapt. Liz Ann Saunders talked about used cars today.
Although we heard, but although this story about the energy bills in the Northeast will offset this, this is the reason why it's such a difficult moment, because it's not just one area or another. Okay, perhaps goods are coming down. Perhaps there are areas where food is actually, the inflation rate is mitigating. But on other areas, heating, in other areas, services, in other areas, plane tickets, you're seeing the opposite.
I go back to rent. I think, and we're colored in New York City by that, but I read with Hawaii the most expensive rent of a state in America, and the West Coast as well. I just think rent has got to be front and center.
Yeah, and if it does come down, how far does it have to come down before it starts to affect some of the main metrics and, frankly, how people feel?
We'll stagger to November 10th, which I believe is out there somewhere. We'll have a CPI report, and we'll do that with all our good guests as we can. We look forward to speaking to you tomorrow from Washington. David Weston leading our evening coverage election night, and we'll be with you Tuesday morning, and, of course, that important Wednesday morning afterwards as well. Futures up 9. Stay with us. This is Bloomberg. Good morning.
satellites have propulsion systems. They can kind of move to get out of the way of each other or change their orbit a little bit. It's a service that you guys offer to help these companies know how to maneuver their machines.
Yeah, we offer a collision avoidance service. It's a subscription service. We'll send you an alert up to 7 days in advance if your satellite's going to come dangerously close to a piece of debris or another satellite.
Companies have been doing that for decades, moving satellites around, but it's sort of like a harder problem now.
The risk of a collision is a lot higher now, just because we've installed so much more hardware into space. You have a big collision, it creates a cloud of debris, and now all the other satellites are flying through this whizzing mess of debris. As we add all of the new satellites into space, the risks of the collision, the likelihood of the collision is going up.
You will put a woman on Mars. You will bring forth global cooling. You will be the first chief crypto officer. Because when you subscribe to Bloomberg, you won't just get news. You'll get insight into limitless possibilities, knowledge, and inspiration to feed your ambition. So before you invent, pioneer, disrupt, before you change the world, Bloomberg.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this
How
story.
are you thinking about those dynamics?
No one covers the world like
The
Bloomberg.
writings on the wall for the Bank of England. Just Stop Oil has spray painted the front door.
Recession in Europe, UK, and possibly the US.
Brazilians are out in full force celebrating the election victory of former President Lula da Silva.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Let's get this trading week started. Live from New York City this morning. Good morning, good morning. Equities up 0.25% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue. After a decade of excess, here come the cuts.
There has been this disconnect.
Despite major headline news about layoffs,
That has not translated into a broad-based weakening of the labor market.
There's clear divergence going on.
first we see stage one, where businesses begin to freeze hiring.
We are looking at the layoff announcements, they're picking up.
Stage two, we start to see sizable layoffs.
We're going to see these layoffs that we were just witnessing show up.
Then we start to see that filter into the broader data.
We just don't see that happening right now.
It's coming from sectors like financial services and tech.
You talk about tech sector layoffs.
Yes, there is some softening in the labor market,
It's inevitable that we see some of those job cuts.
but it isn't in the sectors that the Fed is really worried about.
Let's start the discussion. JP Morgan's Stephanie Roth joins us now. Aberdeen's James Athey alongside us. Stephanie, first to you. What can we learn about the adjustment process that big tech is going through right now?
Yeah, this is probably the first sign of the slowdown that we're going to see in the labor market. Tech companies overhired in the bulk of the pandemic, and it's not surprising that that's the first area that we're seeing weakness. Now, the jobs picture last week was a bit mixed, but we do expect that what we saw from the unemployment rate to be a signal of what's to come. Unemployment should start to rise, and it might take a couple more months before we really see the cracks in the labor market, but that should come. What the Fed has done is enough, and we do think that should result in a material slowdown. We'll probably see more layoffs spread throughout the economy, but it might take a little bit more time.
Stephanie, as things stand, though, what we see is in a narrow part of the economy. It's in tech. You see it in the likes of Lyft, you see it in Twitter, you see it in the chip makers, Qualcomm making cuts, Intel spending cuts, layoffs, etc. Do you see this early signs, then, of a broader breakdown in the labor market, or is it still too early to tell?
Oh, but we do think that we'll see that play out in the rest of the economy. It's just a little bit early. This is a bit siloed at the moment, but we should start to see a slowdown in job gains, and that should ultimately result in job cuts. But we think it's still early. We'll probably see that around the second quarter of next year. We're expecting recession to hit in mid-2023, and that's a clear indication of that.
James Athey, your take on this conversation, and welcome to the show, mate, as always.
Hi, John. Yeah, I mean, I agree. I think what we're seeing is exactly as just been described. Big tech overhired essentially these businesses, extrapolated their blitz scale growth far into the future when most of them really didn't have any right to do so. These businesses are more cyclical than had been assumed, and in a lot of cases they've never really been profitable. They don't have IP which necessarily protects their position, so they're open to competition, and yet investor cash had been thrown at them with abandon. You know, when I see a company like DocuSign with 7,500 employees, I really do scratch my head and wonder what they're all doing for what is relatively simple, straightforward business. And I think we're seeing the sort of tail end of the pandemic effect, right? We had a huge amount of goods consumption relative to services because we were all locked up at home shopping on on internet retailers, and then as the economies have opened up, we've seen this long tail of a switch back into services consumption. It's gone on longer than I expected, but this is a services economy. Service business is low productivity, and it's extremely heavy on labour, so it's no surprise that the labour market has remained strong while service consumption is as healthy as it is. But the shock to incomes, the shock to the economy from this tightening of monetary policy hasn't yet played out, and when it does, I'm sure we'll see joblessness.
James, you mentioned the pandemic. Stephanie mentioned the pandemic. I'm trying to work out whether the excess that we're trying to unravel here is 2 years' worth or a decade's worth of excess. James, which one is it?
It's a good question, John. Yeah, it's both. There has been excess in many areas for a long time, just because of this ultra easy monetary policy forever, the constant provision of liquidity by central banks into markets, which has caused this misallocation of capital. It's caused far too big a percentage of the GDP pie to go to owners of capital relative to labour, and that's a big problem that we need to resolve on a more secular basis. But on a cyclical basis, obviously, when you print money in the size that many economies were, the US in particular, and just start handing out checks to people, then that creates a different kind of excess. So I think the answer is both.
Stephanie, do you view it as both?
Yeah, totally agree there. A combination of a decade worth of excess hiring in the space, and we think that the next decade might look a little bit different from that perspective. But we're also seeing a sort of cyclical near-term overhiring in some of these areas, and we're just working off some of that froth. Now, the next area within...
Yes, Stephanie, carry on, please.
Sure, the next area within the economy is going to be the services sector. Right now, that's incredibly firm, but at some point, the excess cash is going to start rolling over. The impact from higher rates is just going to feed through the economy, and the services sector is likely next.
James, if you two both agree that this could be a decade's worth of excess, James, I wonder what this means for the future of this benchmark in the United States on the S&P. I had this conversation with Michael Schall of Marketfield a little bit earlier this morning, and he made the point that he thinks if you bought the top in the equity market just in the last 12 months, that you're going to have several years' worth of remorse, that we could face a lost decade for big tech, and because of the weighting on the S&P, perhaps big challenges in our future for holding the index, the market cap weighted S&P 500.
Yeah, I mean, again, I think similar to the end of the 90s and the early noughties, it's not to say that there weren't brilliant businesses in there. It wasn't to say that there wasn't an ongoing technological revolution and that would be hugely successful for the winners. It's just the way in which that was blindly applied across the piece to all manner of companies which were assumed to be world leaders and world dominant long before they were, and indeed they were assumed to have a potential marketplace which was global in nature, when actually a lot of them, it was much more niche and it probably wasn't anywhere near as big as was being suggested, and therefore there's a lot of froth to come out. And as you've described, these are market cap weighted indices, so the performance of those companies led them to be dominant in terms of their size within the index. I think when you look at the size of energy, the outperformance of the energy sector over the last 2, 3, 4, 5 years now, it's been a leading sector in terms of performance, but it's still only 5%, something around there, of the S&P, whereas tech's still above 20. That sort of transition, if you like, back to the old economy in some respects versus some of these tech companies, which I don't think really are the sort of world-changing businesses that some have assumed, that's unlikely to happen quickly. I think that's a much slower burn.
So, Stephanie, what do you say to a generation of investors who have been told stay long the index, buy the market cap weighted S&P 500 over a decent enough time horizon, let's say 5 years, it will deliver. What's the challenge to that view now?
I still think that that's the right view. Holding the index, and especially with the U.S. compared to the rest of the world, we still think that it could outperform. We also just have to level set a little bit. We might not experience the returns that we saw over the last decade, but we still think that returns should be decent. So maybe think about growth returns looking more like some of the rest of the index, rather than the index performing terribly over the next couple of years.
Futures right now up 1/3 of 1% on the S&P, on the Nasdaq up 1/3 of 1% also. Talking about the big cuts we're seeing in big tech, seeing it in Meta as well. Meta planning to begin large-scale layoffs this week. That's expected to affect many thousands of employees. An announcement planned to come as soon as Wednesday, according to the Wall Street Journal this morning. Mike McKee has a different story. Morning, Mike.
Morning, John. Well, Stephanie was right. This is kind of siloed within tech, but it's also siloed within the silo because it's really tech firms that have earnings or financial issues right now that are laying people off. It doesn't show up in the broader economy. You take a look at the layoff rate, according to the JOLTS figures, and it's under 1%. And obviously, jobless claims haven't been rising at all. So at this point, right now, the rest of the economy gets up every morning and goes to work. And also, we're hearing anecdotal reports that a lot of startups out in Silicon Valley are licking their chops because a lot of talented people are going to be available in the tech space. Is it going to happen? Well, we don't know yet. This is a kind of a different situation than previous recessions. And yes, there are recession calls out there, but look at this survey from the Conference Board of CEOs. Going into the fourth quarter, 81% said business conditions had worsened, and 85% said they expect a recession next year. But 44% are still expanding their labor force, and 86% say their capital budgets are going to remain the same or increase. Companies don't see a really bad time ahead. So it all brings us to, and I know you're looking forward to this on Thursday, John, the CPI report, to what happens with inflation and how strict the Fed has to be for how long. The New York Fed has an underlying inflation gauge that tells us more about perhaps where turning points are than the actual inflation rate, and it peaked in March and has been coming down since. You look at the two ISMs for both services and especially manufacturing, and they peaked at about the same time, and they have been coming down. A lot of people think that we might see inflation fall faster than Wall Street is anticipating. I'm not making any predictions, but if it did, then we would see the Fed react more quickly, and this could be a whole different kind of recession and recovery than we've seen before, a lot of it pandemic related.
I'll get someone else to answer that question. Mike McKee, thank you. And so that's someone else. Stephanie, that's you. Can inflation fall as quickly as it rose? Is it stickier on the way down?
There might be some elements of it being sticky. We certainly have seen that this year. Shelter inflation has been a big contributor to core inflation, and now Wall Street has come to the conclusion that shelter is likely to start cooling down, but it might take until the beginning of next year. If you look at real-time measures of rent inflation, they've actually contracted on the month. So there are elements with inflation that are a bit lagging, and certainly we're starting to see the disinflation within goods. Services inflation should start cooling in the first half of next year, in part because we expect a material slowdown in growth.
Look how quickly things have flipped in one particular segment. Look at the chip makers. James Athey, look at Qualcomm. Look at Intel. We've gone from a situation where they couldn't produce enough of the stuff to now the cuts. The cuts on spending, the cuts on hiring, the cuts on the workforce that's already at the companies. James, that's happened quickly. Can the rest of the economy go the same way?
I mean, yeah, essentially it can, John. I mean, but obviously inflation is a rate of change, and so you need constant forces driving it higher in order to maintain those sort of large increases. So when it comes to the inflation picture, broadly speaking, higher prices in the past tend to mean sort of lower inflation in the future. That has been the pattern. I think energy commodities are possibly a fly in the ointment there, but in terms of cyclical activity, I think there are plenty of signs out there, not just in the US, but everywhere, that tomorrow is going to be worse than today. And we really are in fairly early stages of this. And as we discovered during the pandemic, right, chips are in everything. So if people are just buying a few less washing machines, if people are just buying a few less cars, all of these things are depressing demand for chips. And because of the lags involved in production, in supply chains and what have you, it's almost inevitably the case that production capacity is increased at the worst possible time. And so you then end up with this inventory overhang, you end up with this supply overhang, and that tends to depress prices even further. We're seeing that obviously in goods inventories in the US, but I do think that'll be part of the story again in 2023.
James Athey, sticking with us alongside Stephanie Roth. To the two of you, thank you. Equity futures positive this morning across the board. Coming up, it's the home stretch. President Biden's final push ahead of the midterms.
One of the most important elections of our lifetime. It's going to shape, the outcome's going to shape our country for decades to come. And the power to shape that outcome is in your hands.
24 hours to go. That conversation up next.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
I think to be successful in a role like this, it is not only technical knowledge. It is about passion.
They have to love Oreos, right?
They do.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Important elections of our lifetime.
You have to get out, you have to vote, or we're going to have a problem.
Our economy continues to grow and add jobs, even as gas prices continue to come down.
Our country has never been so bad as it is right now.
He's doing stuff right now, solving problems right now with a Democratic Congress, and he can continue it if you vote.
You're going to elect the incredible slate of true America First Republicans up and down the ballot.
This election requires every single one of us to do our part. It's that important.
A busy weekend of campaigning and a busy weekend of clarifications. President Biden sparking criticism from within his own party.
It's also now cheaper to generate electricity from wind and solar than it is from coal and oil. We're going to accommodate that transition. No one's building new coal plants because they can't rely on it. We're going to be shutting these plants down all across America and having wind and solar.
Senator Manchin from Virginia slamming those remarks, writing the following: comments like these are the reason the American people are losing trust in President Biden. Being cavalier about the loss of coal jobs is offensive, disgusting. The White House walking those comments back. The press secretary saying the following: the president's remarks have been twisted to suggest a meaning that was not intended. He regrets if anyone hearing those remarks took offense. Joining us now down in D.C. is Anne-Marie. Morning, Anne-Marie.
Good morning, John. What really an embarrassing moment for the Democratic Party ahead of a midterm election. They're having a spat within themselves about the future of energy. Of course, in this statement where the president's remarks were walked back by his press secretary, they were saying that the comments they felt like were twisted, pointing to, without naming him, Senator Manchin's remarks, because the president was talking about what was economically and technologically changing in the energy space. At the same time, John, it also is an awkward moment for the fact that the whole world is dealing with really an energy crisis. We are not as far in the transition as many would have hoped or liked to see. And we see that this summer, we saw that with rising gasoline prices. And unfortunately, we'll probably see that this winter, excuse me, with home heating. And already there's an issue happening in the Northeast because we have incredibly low supplies of diesel to heat homes. And this is something that this administration is already grappling with.
Anne-Marie, the question I've got, and I think this is important for market participants as well, how long is it going to take to get the results from these midterms?
Well, as I told you during surveillance, Jonathan, you and I could be talking about the composition of Congress for the next 4 or 5 weeks, because we may not know until December, because Georgia may end up being a runoff election for the Senator Herschel Walker versus the current incumbent Warnock. That could go into a runoff election, and that may be the deciding factor of whether or not it's the Democrats or the Republican, have control of that chamber.
MH, thank you. Anne-Marie down in Washington. We'll be catching up a little bit later. I'll be heading down to D.C. with the team, Tom Keane and Lisa Abramowitz, for special coverage tomorrow and on to Wednesday as well. Stephanie Roth and James Athey back with us. Stephanie, the first question to you. How do you think this market will deal with a prolonged battle of runoff races, say a runoff race in Georgia? 4 more weeks of this stuff.
I think it might be a bit of a headwind on markets, but I think the more important thing is really going to be CPI. And I heard this morning on surveillance, you were asking guests, which is more important, the election or CPI? I would say the inflation outlook for the next couple of months is going to be much more important, especially when we're thinking about the Fed potentially causing recession in this U.S. economy.
James, do you agree?
Yeah, absolutely, I do. Certainly, it seems unlikely that the House is going to be sort of embroiled in uncertainty for weeks and weeks and weeks. So if the Republicans win the House, then essentially the Democrat lock on Congress is over. And of course, it does make a difference at the margin whether the Democrats are in control of the Senate, but it doesn't become such a big issue then. So presuming, as we expect, the Republicans win the House and do so fairly handily, the fact that the Senate race drags on, I don't think is significant for markets particularly. I agree with Stephanie completely. The CPI number has the potential to be a much more dramatic market moving event.
From the market's perspective, I get all this. I understand that in the short term, it's all about having some certainty over fiscal policy, perhaps constraining the ability to deliver more fiscal stimulus and spending that would complicate the Fed's effort. We've got all that, Stephanie, in the near term. What I struggle with in the longer term, Stephanie, if we don't have the availability of a counter-cyclical fiscal buffer at a time when the economy is rolling over, do you think we revisit this and say maybe actually it's not that bullish having divided government?
I think we have to assume that we're going to be having divided government, in which case the market is likely, pricing that in to some extent. We're not expecting to have a big fiscal stimulus in the onset of recession next year. So it's likely all hands are going to be on the Fed in order to stimulate policy, and they probably will, but it might take some time because they want to make sure that inflation is truly cooling. So we shouldn't really expect much from fiscal next year, and I don't think the market was surprised by that.
James, your response?
Yeah, I mean, I completely agree. One of my biggest concerns, and this has been the case for quite some time, is just the extent to which we believe that each and every recession requires some dramatic policy response to offset it. Because there's nobody sitting around any of the tables who's prepared to accept any short-term pain, and in doing so, they're quite often sacrificing long-term stability and the long-term health of the economy. I think one of the big issues is that things have become so imbalanced because there have been so many and so frequent efforts by policymakers to deal with any and every little downturn in the economy. The idea of Schumpeterian creative destruction has been completely eschewed, and in doing so, we have however many zombie companies in the US which are sucking up capital and not using it productively. We have savings which is way too high because we have such a skewed sort of concentration of income and wealth amongst people and amongst corporations. We have reduced competition across a number of sectors, which permits that to happen, all of which is a headwind to potential growth, to structural growth rates, and short-term spending actions from governments and easy monetary policy as far as the eye can see are not helping these problems, they're making them much worse. So it would be nice, in my mind, if we could get to a place where governments were investing for the long term and monetary policy was far less activist. But I'm not holding my breath on that front.
I'm not sure they're going to embrace your view of Austrian economics anytime soon either, James, but we can run with this just briefly. Stephanie, I hear a lot of people say short and shallow. Our audience hears that all the time. If there is no counter-cyclical buffer here, a counter-cyclical circuit breaker from monetary policy anytime soon, from fiscal, it's not going to have the ability. Doesn't that tell you something about duration of a potential downturn? Could this persist longer than people think?
Sure, we think it could look more like a typical recession, a recession that lasts about 4 quarters, has an unemployment rate rising up to 6%. The argument that it's going to be specifically short, I think, is a difficult one. But where we would push against is a severe and deep recession. That we don't think will happen. So we don't expect anything like the great financial crisis. The economy is fairly healthy. There's not that much leverage in the system. But sure, it could look like a normal type of recession where you do get job losses and the unemployment rate does rise.
There's been nothing normal about the last 20 years. Stephanie Roth, James Athey, to the both of you. Stephanie, thanks for joining the programme. James, to you as well. Futures right now at 0.4% on the S&P. Coming up the morning calls and later, the man himself, Morgan Stanley's Mike Wilson, on why the bear market rally might be able to continue. That conversation coming up. The opening bell, just 7 minutes away.
Some years ago, this little town became famous for having 5 centenarians and made it to the cover of National Geographic, having 5 centenarians out of a couple of thousand people.
Io 102 anni. Qual è il segreto? Non lo so. Io mangio sempre semplice.
Fasting is such an interesting part of the longevity conversation. And ask the question of, well, why are these people living so long?
Fasting has been done for thousands of years, of course, but we now have to move away again from these ideas of eating or fasting. They both mean very little. I've seen 110 healthy, but it's not going to be doable for the entire world population. It's going to be doable, I think, for the people that listen and follow all the right moves.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Minutes away from the opening bell, equity futures up 1/3% on the S&P, coming off the back of a week of losses on the Nasdaq, down by about 6% last week. Biggest weekly loss going all the way back to January of this year, trying to bounce back again and build on Friday's gains. The Nasdaq 100 up 0.4%. That's the price action. Let's get you some morning calls. First up, Wells Fargo downgrading Costco to equal weight, 490 price target, highlighting a weakening consumer and potential currency headwinds. That stock is down by 1.6%. Next up, Berenberg downgrading Estee Lauder to hold, 220 price target, saying the company lacks visibility on a potential recovery. We're down by 1.6% there to 207. And finally, Barclays trimming its Apple price target at 144, seeing growing risk to Q1 estimates after cutting its outlook for iPhone shipments. We're down there by 1.3% at 136.50. Coming up, Morgan Stanley's Mike Wilson expecting the midterms to keep the bear market rally going. That conversation just around the corner, with equity futures up 1/3% on the S&P. This is Bloomberg.
hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you would be.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
From New York City,
From London and Sydney.
from Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this
How
story.
are you thinking about those dynamics?
24 seconds away from the opening bell. Equity futures just about positive, up a third of 1% on the S&P as we kick off a new trading week, and I say the same thing every single Monday. Big week ahead. CPI coming up in the midterms. I would say it's a big week ahead on the Nasdaq right now, up a half of 1%, kicking high on the Russell as well. The small caps of 6/10. There's your opening bell. Switch on the board and get to the bond market. Yields look like this on a 10-year, unchanged on a 10-year at 415.45. In the FX market, euro dollar had a sneak peek at life again, above parity a little bit early this morning. Right now, back to 99.94. We're positive 0.4%. Crude unchanged, 92.53. Still trying to get used to it again in the 90s. 92.55 now, basically unchanged on the session. At the opening bell on the S&P, we're about 20 seconds into this. I'll bring up the scores on my terminal. On the S&P, up a third of 1%. Utilities kind of lagging at the moment. Communication services top of the pile, up about 0.9%. Breaking things down for you is Katie Greifeld.
Hey, John, well, let's start with Meta after that Wall Street Journal report over the weekend that the company plans to start cutting thousands of jobs this week. Shares are actually rising, though, and that's what's interesting. Maybe because the company is starting to get serious about cutting costs. This, of course, as it's still burning billions of dollars in the metaverse, but that's another story. Apple, too, we've got some news there. The company said that shipments of its newest premium iPhones will be lower than previously expected. The company said demand is still strong, but it's China lockdowns that affected operations at a supplier's factory. That means longer wait times ahead of this holiday season. Shares only off about 0.5% or so. Outside of tech, well, let's talk about Disney because the stock is rallying ahead of tomorrow's earnings report. Disney expected to widen its streaming lead over Netflix. Shareholders seem excited. Shares are higher. JD.com also in the green. It's one of several Chinese internet ADRs higher this morning. The government there saying that COVID-0 policies are still in place. That theoretically means more time spent online. You can see JD.com shares up over 3%. Back in the physical world, though, you have U.S. natural gas soaring this morning. That's as a winter storm hits the Pacific Northwest. That's boosting lights of Southwestern Energy and EQT, John.
I've got complaints about Disney's Hulu, Katie. Have you seen the price increase from $75.99 to $82.99?
My husband handles that, John.
Does he? That's not your thing. I'm handling that right now. It's a problem. Katie, thank you. The S&P up 0.4%. I'm not sure I've handled that at all. Taylor Riggs, on to the midterms.
I was going to say, you only like Hulu because the Kardashians are on it, John. But
How did you know? How did you know?
Because I know that you love Kendall Jenner and Kendall Jenner only.
This
but
is true.
Let's get to the midterms. And on a serious note, those opening bell that you talked about. Take a look historically, really interesting calls coming out this morning. On one hand, you Morgan Stanley saying, yes, the traditional sort of correlations hold up in midterms. Equity to December looks pretty good. Evercore ISI, though, coming out and saying,
you know what, maybe not so fast. This year could prove to be different. Regardless, I know that we'll all be keeping our eyes on tomorrow and sort of the performance as we head into the end of the year. Take a look at sort of the probability. Hard to be a betting person, but when we take a look at the MAGA ETF relative to the Democratic ETF, in that terminal chart, you'll see that maybe the Republican ETF rises just a little bit relative to that, and then predicted the odds of both a Republican House and a Senate. And that is the blue line as well, elevated but off the highs of the session. So if you're a betting person, that's one way in which you can look at it. I think all in all, John, though, for the market, how we're thinking about this is how is equity performance heading into the end of the year in a mid-year year. And this is it. November actually looks pretty good. It looks really good in a midterm year, much better than either an election year or neither year. So that is the momentum heading into this month.
I was a big fan of revenge bodies with Chloe as well, for the record. No one believes this anyway, so it doesn't matter. Taylor, thank you. On the equity market, on the S&P, up 1/3 of 1%. On the NASDAQ, up 2/10 also. Morgan Stanley's Mike Wilson expecting stocks to overcome another challenging week. He wrote the following this morning. The bear market rally was severely tested last week with the Fed's clear message that it's far from done. We think it survives again, with the midterms providing the catalyst for lower bond yields and higher equity prices. I'm pleased to say that Mike joins us right now. Mike, I want to start, if it's okay, of course, with last week's note, not the week over the weekend. When you said the Fed meeting is critical for the rally to continue, pause, or even end completely. Mike, when I watched that Fed meeting, I was kind of kneeling or kind of leaning into the end of that one, maybe it ending. Why can this continue?
Yeah, thanks, John. Good to see you. I mean, look, we got to be flexible here. And what I would say is that the message last week from the Fed was pretty mixed, right? The statement itself was dovish. You know, the market rallied off of that. And then the press conference was a bit more hawkish. And look, this is the ambiguity that we have now, right? People have to interpret these statements and these reactions on their own. It's not going to be that exact anymore. The Fed doesn't exactly know how they're going to end this, and neither does any investor, including ourselves. What we do know is that we're getting closer to the end, and the rate of change probably on the pace of hikes is coming down. And that's our forecast, 50 basis points in December, 25 in the January meeting, and then they pause from there. And that's a quick ending. So that's enough for the bond market to potentially rally at the back end, particularly if we get the outcome in the elections that we expect tomorrow.
Let's get to the midterms in a moment. Do you consider the end of hiking the end of tightening? And it sounds like you do. So let me ask you this. Would you consider a Fed that pauses and stops hiking, but a recession that rolls over to be tightening or not?
Well, it's all one and the same, right? So the Fed is likely going to achieve its goal. It already has in terms of slowing the economy. Ultimately, I think they'll be successful in getting inflation down because it's not really about the Fed so much as it is about the excessive fiscal spending and of course, what that did to demand. And that is already fading because of demand destruction from prices and, of course, as people run out of money. So I think it's all one and the same. And look, the trickiest part here, John, is that, do we decide, is there going to be a window of opportunity between the end of the Fed hiking cycle and the recession itself? This summer we wrote about that. We said it's too early to think about the Fed ending its rate hike cycle, so we didn't try and play that rally. This time, though, we think there could be this little window of hope, particularly at the year end when there's pressure to perform and people have to chase stocks into year end potentially. And as Taylor was saying, the midterms historically are a positive catalyst for at least for the month of November.
Well, let's talk about where you want to be long within the equity market. The recent outperformance in the equal weight S&P over the last couple of weeks is clear for all to see. What's the signal you take from that, Mike?
Well, I think that the equity market leadership is fading, right? So technology has been a massive underperformer this year. Consumer discretionary as well. We've been underweight those groups. And the question, of course, is what's going to take over? And I think what's interesting, what we're trying to do, John, is we look at the internals of the stock market to help guide us, and we're getting close to the end of the bear market. We're not there yet, but what you want to try and figure out is what outperforms in the last leg down, and because that will tell you what's going to outperform in the next leg up eventually when we get there. And that's been industrials, financials, and some of the commodity complex. And that makes perfect sense to us, right? In the next economic expansion next year, we think that there will be a major leadership change from the former leaders to this new areas.
You think tech gets left behind?
Well, look, I mean, the reality is that there are plenty of good tech stocks that will be fine. The reality is that there's too many of them, right? And they got overvalued. So it's not that technology is dead in terms of the spending trends. We're very bullish on technology spending. However, there's too many competitors now, and the valuations just got out of whack, so we got to take that out. And yeah, so there'll be a lag. There'll be a laggard probably in the next recovery cycle, but that doesn't mean there aren't great single stock opportunities within that.
The midterms, let's go there. It was in your note this morning. Is that just a risk event, Mike, we need to clear? Or does it have outcomes that have consequences one way or the other?
Yeah, no, I view the CPI as kind of this risk event that needs to just get it out of the way. It's sort of like, who cares? You know, it's backward-looking data anyways, but we gotta get through it, and then we're pretty confident that 6 months forward, inflation will be materially lower. That's our forecast, and so it's just that's kind of the risk event that just has to come and pass. The midterms, though, however, could have lasting implications if it's a decisive victory for the Republicans, because, you know, as I said before, we think the majority of the inflation spike was a result of excessive fiscal spending, and that, of course, will be curtailed even if the Republicans just win one chamber. That's not to say that the Republicans are fiscally conservative incredibly fiscally conservative, but it does throw a wrench into this idea of a single party, which the market also likes, the idea that no one party having single control. So ultimately, it should be good for bonds. Bond yields lower has been key to our tactical rally call, as you know. And look, I want to make it perfectly clear, John. If we don't get rates to come down, the rally's over. We had it 39, 39.50, but we see enough in the tea leaves and enough in the technicals to suggest we should hang out and see these two events this week play out first.
Mike, different views though, and you've written about this in the past, so I'd love your view on it now. Are rates going down because there is this increased perception that the cycle's ending, the hiking cycle's ending, or are rates going down because perceptions of global growth are rolling over? And in the near term, I get it, you trade on just the move, but when do you start to trade on the reasons for the move into next year?
Yeah, look, so we have to kind of serve many constituents. This is a trading call, okay? For our core, kind of view, we remain of the view that the bear market is not over, primarily because of the view we've had all year, which is that earnings ultimately will decide the end of the bear market. And we think earnings expectations for next year are significantly too high, maybe as much as 20%. And that will happen over the next 3 to 6 months, meaning the numbers will finally come down. Part of the reason we threw in the towel on that happening now is because we just got a sense that companies wouldn't talk about 2023, which they did not, and therefore the earnings remain high for next year. But I want to make it clear, over the next 3 months, we think that will change. We think companies will discuss 2023, and the reality will set in that the numbers have to come down. That will form the bear market low probably sometime in the first quarter next year.
Are we seeing signs of that now with some of these tech companies, Mike, reporting cuts, hiring freezes or layoffs?
Well, let's separate that because, first of all, we saw many of these large tech companies report, pretty weak third and fourth quarter. But then when you actually look what happened in 2023 numbers, they didn't come down that much, at least for the majority of them. And part of that's just, kind of laziness of the numbers. Nobody talked about it, so they just kind of keep them there. But then I want to talk about the cost cutting. Okay, so look, this is what will get us bullish. By the way, if we saw more aggressive cost cutting, not just by the tech companies, but by companies more broadly, this acknowledgement that we have a cost problem. And, obviously we don't want to see people get fired, but, layoffs, unfortunately, are a part of that slowdown. When that layoff cycle picks up in earnest, that will actually be one of the keys for us to get bullish, because that means the bleeding will stop on the operating leverage.
Final question. You hinted at the answer to it a little bit earlier in the interview. I've asked this question all morning, Mike. You get the choice, the outcome of CPI or the outcome of the midterms right now. I can give you one. What would it be?
If I could see it right now, Clarence speaks, I would say I'd probably rather see the midterm election outcome, because that has more lasting impact potentially.
Mike Wilson, thank you, sir. As always, Mike Wilson there of Morgan Stanley. Still looking for that bear market rally to continue through the next couple of months. Equity futures were positive going into the open. We come out the other side about 11, 12 minutes into the session. We're positive 0.2%. In the cash equity market on the NASDAQ, we're basically unchanged. Coming up, debate over China's reopening plans reaching a fever pitch.
I'm not quite sure what a pivot on COVID lockdowns quite means in China yet, but it's certainly not going to be a sudden reopening as we saw in the Western world. It's going to be more nuanced.
And the latest on Apple's production difficulties. That conversation up next. you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Gen Z can't seem to get enough of Prada. Loafers, nylon bags, and its Miu Miu micro miniskirt have been flying off the shelves into and onto the arms of young consumers. Fashion tech company Lyst placed Prada second on its fashion index at its highest ever ranking. So what could be making this over a century-year-old fashion house appealing to a new generation of consumers?
What Prada has navigated adeptly is their overall kind of understanding of how cultural conversations are happening online, their ability to partner with various cultural figures.
Gen Z faces are at the front of Prada's advertising to this new market. Maya Hawke, Hunter Schafer, and Sydney Sweeney will be familiar to any fans of Stranger Things or Euphoria. There could be another factor at play, the environment. Of those surveyed by The Lancet, over 59% of Gen Z said that they were extremely worried about the climate crisis. So, for example, the revival of Prada's iconic nylon handbag using eco-friendly materials may be winning kudos among these shoppers. Of course, Prada and Miu Miu are not inexpensive brands, and as the global cost of living crisis hits, these brands might start to feel a pinch. But, for now, Gen Z seem to be reaching for their nylon handbags and not letting go.
The top names in business are on Bloomberg.
The financial services industry, which is a large part of the UK, is very competitive. But it's not the only one. Health sciences, even technology and fintech are very, very bright stars in the UK.
The market environment is a very challenging one. It's not about blaming the markets. The markets is the same for everyone. And that's exactly how we deal with it.
90% of our clients are indicating we need more guidance. And if they want more guidance, that's why they bring their money to us.
Nobody covers business like Bloomberg, your global business authority.
I'm not quite sure what a pivot on COVID lockdowns quite means in China yet, but it's certainly not going to be a sudden reopening as we saw in the Western world. It's going to be more nuanced. And as such, I'd be a little bit cautious about some of the optimism which is happening in Hong Kong.
Economic headwinds piling up as China doubles down on its COVID-0 policy. Health officials saying previous practices have proven that our prevention and control plans are completely correct. This as the demand slowdown worsens, China's trade taking the hit, with exports falling and imports shrinking for the first time since 2020. Mike McKee and Damien Sassow here with the latest. Mike, morning.
Good morning, John. Well, you can easily see what the problem is with China. They have been much more strict than the rest of the world. When you take a look at the stringency index, the measure of how tight their policies are on locking down, the U.S. and I just picked Germany have fallen tremendously, and we're pretty much reopened, whereas the Chinese, you can see, are still very, very tight. And that's having impacts across the board, not just on trade. You mentioned the exports and imports, but Chinese growth remains really slow. Their trade surplus widened because imports are so low at this point. 10% of China's GDP still under lockdown, according to Nomura. And there are rumors of a COVID-0 policy change that, as you mentioned, are being shot down by the government. So nobody quite knows what's coming out of China, except that some companies, like Apple, are having problems.
There was a massive frenzy last week, Damien Sassow, in the market off the back of these hopes. What's the truth to all of this, Damien?
Well, first of all, I don't know what the big surprise was. I mean, it was obvious that exports were going to get a hit here. I mean, look at South Korea. Exports declined for the first time in 2 years. Look at freight rates between Shanghai and Los Angeles. They're down 80% over the last year, Jonathan. So things were boiling to a head. But to your point about the equity market action last week, look, what it says is you've got very, very light positioning from foreigners in China. And so it doesn't take a whole hell of a lot to move the needle. And that's exactly what we saw. Look, I mean, I'm not suggesting that there's real value in China right now, given the geopolitical and legal overhang and the property sector, of course. But the reality is, light positioning makes for easy markets. And so I think that's a lot of what we're seeing here.
Well, it was a messy market over the last few years, that's for sure. Damien, Mike, thank you. Mike mentioned Apple. Let's talk about Apple. The COVID zero policy in China weighing on multinationals. Apple feeling the pain and seeing significantly reduced capacity due to COVID restrictions. This coming amid a Bloomberg report blaming demand woes for at least 3 million in total production cuts for the iPhone 14. Ed Ludlow has to make sense of this. Morning, Ed.
Yeah, good morning, John. Apple down for a 6th straight day, its worst run of declines since January, the stock trading at its lowest level since June. You're right, 2 key pieces of news, one on the supply side, one on the demand side. Let's start with the demand side. Apple expects to produce 3 million fewer iPhone handsets this year. According to sources, it's instructed its suppliers to build 87 million, down from 90 million. And according to sources, that is principally due to softness in demand for the lower end base iPhone 14 handset models. You'll remember in September, Apple had actually originally instructed its suppliers to boost output of the iPhone overall, but then walk those back when we got those initial pieces of soft demand. And then at the same time, there's the supply issues too. Apple said Sunday that shipments of the premium iPhone 14 Pro models will be lower than expected due to COVID lockdowns, in particular in the Zhengzhou region, where Foxconn, its principal assembler, has the bulk of their activity for the Pro models, the higher end versions of the iPhone 14. Apple also warning customers globally that as a consequence of this, there will be an extended waiting period to get your hands on an iPhone 14 Pro model. Why is that important? We're in the final 3 months of the year, the key holiday season. The street very much worried, not just about volumes, but about the bottom line as well, because the net result of this being fewer handsets is also the mix will change. Fewer shipments of the higher ASP, higher margin Pro models should impact the bottom line. There's also a really interesting take from UBS on this, John, real quick. They're saying that the market has not yet factored in these disruptions in China for fiscal 1Q or full year 23. And then actually, according to UBS, the market is, quote, way too optimistic in its revenue and earnings projections for Apple for this year, which indicates actually we should take this much more seriously than the street currently is.
And how seriously are they taking it? Are they rethinking production in China?
Yeah, I mean, we already know the story here, right? Particularly as it relates to Foxconn, the main supplier that assembles the iPhone. They're trying to shift away from a reliance on China to India. But the reality is that 80% of these higher-end iPhone 14 Pro models are assembled in the Zhengzhou region. This is an area that we've reported on, right, where they've been hit hard by quarantines. Workers have fled the region because they can't get into their workplaces. And right now, the government, relating to what Mike was talking about on the policy side, only are allowing medical personnel onto the streets of that city. It's impossible to run a factory in that scenario. So yes, long-term, Apple looking outside of China and towards India principally.
Apple down for a 6th day. Ed, thank you. We're down by 1.8%. Ed talked about the analyst community. B of A, Barclays, both cutting targets this morning. Deutsche Bank lowering Q1 estimates. JP Morgan saying Apple. And the latest news implies downside to Q1 estimates as well. Just a range of analysts rethinking maybe the story on the margin. The S&P up by a little more than 1/10% with a sector price action. Back with us, here's Katie.
Well, John, the S&P 500, it's just about flat, but you actually have 8 of 11 sectors higher right now. Energy is out in front. You do have crude back to flat, and like we talked about, you have U.S. natural gas surging this morning. Consumer discretionary to the downside. That's a lot of the travel names. But the story this week, of course, is the U.S. midterm election. So let's look at what the sector action looks like in the run-up. Over the past week, it's interesting. You have aerospace and oil services, those pipeline companies. They've both rallied relative to the S&P 500. Not fantastic gains, but for context, you have the S&P 500 down about 2.4% over the past 5 days. On the other side of the trade, you have green energy, those cannabis companies, both trailing the big benchmark. So it could be a sign that markets see Republicans winning control of Congress. But, John, your guess is probably as good as mine.
I don't have a guess right now, Katie. Clueless, as always. Katie, thank you. About 20 minutes into the session, equities down now on the S&P by 1/10, on the NASDAQ by 0.4%. In the bond market, up 6 basis points at the front end. Your 2-year all over the place last week, close to 480 post payrolls in the first few minutes. Then the lows of last week, close to 440. Right now, 472. 472. highs we haven't seen in the last week, going all the way back to maybe 2007. Up next, your trading diary from New York. This is Bloomberg.
Incredibly difficult for all types of companies to find employees lately. Many people with disabilities who aren't working could be working if only given a job. About 20% of people with disabilities are employed.
Right now, we're in an environment where there is a war on talent out in the marketplace. Every employer out there is struggling to find people to come into their shops and to find good, hard-working, dedicated employees. We have found through this program and other ones like it that we have within the organization that these individuals are looking for meaningful employment.
People with disabilities want to be able to live, work, and recreate in the community the same as everybody else.
Many of us identify ourselves right away by our job title. That's an important part of our image of ourselves. So that's true for all of us, whether or not you have a disability.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
25 minutes into the session this Monday morning. Good morning to you. We are basically flat on the S&P, negative 0.2 on the Nasdaq 100. Some losses this morning, marginal losses on the Nasdaq, and adding to the losses of last week, down 6% on the Nasdaq 100. Worst week coming all the way back to January. The bond market looks like this: 2s, 10s, and 30s. Your 2-year. Look at the front end, up 6 basis points again and back through 470, 471, 75 on a 2-year, just off the highs of Friday, which were close in and around 480. That's the price action. Let's get you the trading diary. Big week ahead. White House press briefing coming up at 1:45 Eastern time. Fed speak picking up with Collins, Mester, Barkin all on deck. US midterm elections on Tuesday. The results on Wednesday. Might take longer than that. Then we get more Fed speak. Williams, Barkin speaking on Wednesday too. And finally, jobless claims followed by another big CPI print in America. CPI Thursday, just around the corner. From New York, equities basically unchanged. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the
most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
I think to be successful in a role like this, it is not only technical knowledge. It is about passion.
They have to love Oreos, right?
They do.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Bloomberg is live at COP27 in Sharm el-Sheikh, Egypt. Bloomberg Television and Radio brings you continuing coverage as world leaders, business insiders, and decision makers gather to take action toward achieving the world's collective climate goals.
What are your top 3 priorities?
There is an ability always to find the new and innovative ways to meet the challenge and at the same time take into consideration the pressures that exist.
Special coverage continues only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Monday, November 7th. Here are the top market stories that we're following for you at this hour. T-minus 24 hours. U.S. midterm elections around the corner. The House expected to go red, Senate up for grabs. We get the latest on the horse race. And midterms, a catalyst for markets. Mike Wilson of Morgan Stanley sees more of a bear market rally ahead of the elections. We're going to game out how to trade and where the risks are. And tech layoffs, sorta. Twitter lays off people, asks some of them back, and Facebook could cut workers as early as Wednesday. We're going to speak to Brad Smith, Microsoft president, to get his take on the industry. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome, everyone, to Bloomberg Markets. Guy, just focusing on the midterms, I think that Lori Calvasina of RBC said it best in her note. The bigger the Republican win, the bigger the equity surge.
Absolutely, which seems quite logical in a way, doesn't it? You are going to get divided government, you're going to get less spending, you're going to get less inflation. That feels like a logical way of working this one through. I guess my caveat to all of that would be kind of what Evercore has said today. You get any kind of political concerns about the validity of the election, then all bets are off. And I think that's going to be something to definitely watch out for. Yeah. It's not as if the US has had a great track record recently with elections, and as a result of which we can't ignore that as a factor. 100%. And also, I mean, we probably may not know who's going to win the Senate by Wednesday. So will that uncertainty either cause volatility or just put off any kind of rally we may get on a gridlock Congress? I don't know. I think that these are the questions to tackle. Yeah. And I think you've got to look state by state. I think you've got to look at region by region just to figure out what's going on here. All of this is going to be important as well as we think about what's going to be happening going forward into 2024. Because, yes, by the end of the week, I suspect we're going to be talking about that as well. Mike Wilson of Morgan Stanley out with a note, as ever, over the weekend, putting his finger on it, basically saying investors should stay bullish on equities ahead of this week's U.S. midterm elections. Today's question of the day, what is the midterm trade? Let's try and get an idea of how you should be positioning, what you should be saying and thinking as we work our way through this process. Bloomberg's Vincent Signorella joins us, as does Bloomberg's Simon White of the Market Live blog. Simon, I'm going to start with you. You've got two big events coming up this week. You've got the midterms, you've got the CPI. Just talk me through the midterms from an inflation point of view, sort of through that perspective, because that's what the market's big concern is right now. Inflation is what affects everything. So how does this affect inflation?
So I think a big change came with COVID. The attitude to crises was to spend more money, and which meant that the US government, along with other governments, kind of lost fiscal credibility. And so that means the response to governments borrowing more is very inflationary, much more than it used to be. So if you get any other result in the status quo after the midterms tomorrow, then I think you've opened up the opportunity for less fiscal spending, which should mean less structural inflation risks. But I also think that the kind of attitude might change politically, that the pressure now has been very much in the cost of living crisis. Coming out to the midterms, once the midterms are out of the way, that pressure might be relieved. So there might be less pressure on the Fed to keep up this very extreme hiking cycle. So I think some of the data that we'll see in subsequent days will kind of begin to test that.
Hey, Vince, talk to me then about what you think the trade is. And I'm kind of leaning towards the dollar if you want to go there, because I still can't quite get a grip on why the weakness we've seen the last couple days.
But the weakness in the dollar, it's just simply the inverse correlation with the S&P 500. As you see risk rise, the dollar will sell off. We're seeing bouncing off the lows a little bit today because we've seen a little back up in yields, and of course higher yields do tend to support the dollar. But I think if Mr. Wilson is correct, and I think he is, if we do see a Republican majority in the House and the Senate, we will see a risk rally. We will see the dollar roll off, and it's going to be twofold. Number one, markets absolutely love when Washington does nothing. And so we'll have a lame duck president and a Republican House and Senate. And about the only thing that's going to get accomplished will be positive for equities, which, as Simon mentioned, lower spending. But one thing no one is talking about really is the potential for resurrection of drilling, the Keystone Pipeline, all positives for energy and all positives for the reduction in energy costs, at least from a psychological standpoint. It's going to take Keystone years to come online. But if the Republicans manage to put that back in the game, you're definitely going to see energy prices moderate, and you're going to see inflation moderate. That's going to help the Fed a lot.
Simon, let me come back to you on one of the stories that we mentioned right up at the top, and that is the risk of political instability. Markets do not like political instability. We've seen it in the UK, we've seen it elsewhere. The United States has a recent track record with it. If this week turns out to be turbulent, how big a market reaction could you get? How much of a risk-off reaction could you get?
Well, the market has been quite skittish of late. Like we've talked before about poor liquidity in the treasury market. So any kind of vacuum of information is not going to help that. You know, one thing I've been looking at, for instance, is the kind of preternaturally low level of the VIX. On any way you want to look at it compared to cross-asset volatility or at-the-money volatility, it just looks very low, and it's been trading off again. So I think any kind of change to the environment after the midterms, or certainly any volatility or uncertainty, you could start to see that start to move. And as I say, you could see larger moves in yields because of that terrible liquidity that you have in treasuries.
So to that point, if we do get uncertainty and we do get that volatility, Vince, is the dollar in that instance a safe haven or no?
No, I think it would be. I think there's going to be very few places to turn if we get this kind of major risk-off, major political disadvantage, if you will, with the turmoil, not knowing what the results are. And, you know, some states have already warned, Pennsylvania in particular, that the results are not going to be known the day after and maybe take days to come. And that just creates a little bit of an angst, I think, in the voting public and confidence-wise, where, you know, you start to see people, you know, create these rumors, if you will. And that is certainly not positive for global equity markets, not just here in the States. So you're probably going to see some sort of a risk off, some flight to the dollar, at least in the near term, until the results are certain. And then even when the results are certain, will people believe them? Will the losers in the elections admit that they've lost those elections, or will they cause some trouble afterwards? You know, we've seen the pattern where, you know, when the election is finally decided, the person on the wrong